Is this the end of the uranium bull thesis? That's going to be the main well, a couple of topics. Of course, that's going to be one of the topics we're going to discuss here today, Yellow Bull and I. But we just had a nasty uranium crash that, by the looks of it, has shaken the confidence of many a Twitter punters and YouTube commentators, and maybe rightfully so. The URNM is down about 40% since it's recently reached all-time high that it hit in late May of it was right over $60 actually. And then its little brother, the URNJ ETF, lost basically half of its value in that same period, with the spot price losing about 20% again that same period since about May up until now, late May up until now, which is early August. But in the meantime, we had Cameco's earnings report, a Cameco warning there, I see. They talked about production a lot in there. So that's something Mart and I will discuss. There was news out of Kazakhstan about their tax regime. They have more transporting issues. We'll talk about that. Hopefully, touch upon Uzbekistan as well and whatever's happening there. There's been changes in uprisings in West Africa. There's a couple of new, well, not a couple, but there's a new permit that we might touch upon later on as well. And there's, of course, a ton of nuclear news happening all the time. So, again, there's plenty that Mart or YellowBull and I have to talk about. And right after that, I will also have a conversation with two uranium CEOs. And there's going to be one returning guest for an update on Skyharbour Uranium. And there's going to be one new company introduction, well, new to me at least. This is the first time I'm going to be talking to Premier American Uranium. So Collins here. This is, by the way, a Mike Alkin company. So again, interesting stuff. Loads to go through on this episode of Transition Talks. But of course, Mart, kicking it off with you because, and by the way, it's been too long, okay, since we last spoke, and there's no excuse for that. We should do these things more often. Next time I'll physically make you. Oh, and by the way, for people who don't know, again, as I mentioned, Mart is, first of all, my obviously better looking twin, but he's also YellowBull on Twitter, and he's the Contrarian Codex on Patreon, which is where he posts his own analysis and interviews and whatnot, most recently with Global Atomic with Stephen, which must mean, Mart, that you know what's going on, or at least I hope you have a better idea than I do, because I have absolutely no idea what's happening. But I'm seeing three massive red candles for the last 3 weeks and pretty much all the charts that I could find on uranium stocks. And it just feels like this crash might be it. So I don't know. Is the thesis over? Was that it? So what do you think? Should I be panicking? Should I be getting nervous?
Well, let me start us off by saying that yes, we should speak more often. Like we've been speaking for like 4 years, but with various large intervals. But no, I always like to chat with you, and you produce some great value. And congratulations, by the way, on 50,000 followers. I think it's
Thank you.
very, very well deserved. But moving straight into uranium, and yes, I can see why people are quote unquote panicking, quote unquote nervous, or however you may call it. I use my own sentiment modeling. I go through various different ways to get a sentiment reading between 0 and 100,
Hmm.
divided between intervals of 10 going all the way up to 100 if we're very, very bullish, like euphoric, like the things you see at major tops, all the way down to 0, where pretty much everyone has either left the sector or thrown their PC out the window or their phone, depending on where they're watching their portfolio at. And right now we are at 8. And that has usually, it almost never gets this low. And the only reason it has gotten this low, in my opinion, is because of broad equity market influence. And what I mean by that is, to directly answer your question, no, I do not believe that this correction, for anyone wondering right now, that this is based on fundamentals. We saw a little bit of the market getting, let's call it nervous, after Chemical came out, and they're doing, and we can get into that, and they're doing a very good job at ramping up their production. They gave no indication, apart from Inkai, which we can get into, that they would be suffering any supply constraints. We saw Kazatomprom actually going out and saying, okay, we can actually up our guidance a little bit, which was
Hmm.
solid from them. So roughly, I think a 4 to 7% production increase from 21,000 to 22,500, I believe, which was the guidance back in March of this year, to now 22,500 to 23,500, which is that 4 to 7% increase, depending on which end of the range they end up at. And I think that kind of scared the market. Like people were believed that Kazatomprom would be facing much bigger issues and that they wouldn't at all be meeting their production targets this year. Maybe they were scared by that, but in general, I believe that had a broad equities market correction like we saw it not happened, then we would be either in a bottoming process right now or even going back up. And looking at this, looking at the broad equity market risk, it is, in my opinion, really not a surprise that we've seen this. I monitor a lot of macro indicators on the Codex as well. And on the 16th of July, we saw the market top out. And on the 17th of July, what we saw in the S&P 500 was a 1% or more decline. Now, for anybody listening right now and saying a 1% decline, this is a decline for ants. Like if you've been in uranium, you've seen 5% intraday declines, and a 1% decline is nothing. It's a rounding error for most people listening right now that are used to the volatility of commodities, not just uranium. But the important part of that is with the data set that I follow, it was a 54-day streak, 54 trading days in a row without a single 1% decline. That was the longest streak since 2019. And every single time that volatility or suppressed volatility streak goes above 40 or even 35 and it breaks, you usually get a lot of volatility following that. And given how elevated we were, I made a calculated bet that after the 17th, I posted a Codex update on the 18th where I noted that, hey guys, this suppressed volatility streak has broken. I think that we're due for a correction. We built a cash position following going very long in Q1 on precious metals. We sold most of that in May, or at least part of that in May. And that built a cash position because I was very worried about the broad equities market really providing a gut punch. And Antonio, we're working with I believe like a cumulative market cap of all publicly traded uranium companies around $60 billion, maybe a little bit less now after this correction, maybe 50, 55. But most of these equities, they can move on a few motivated buyers or sellers because they're so illiquid. And when the entire broad equities market takes a turn, these get thrown out like a baby with the bathwater. And yeah, it hurts. And it might get worse before it gets better. I'm in the process of doing a lot more macro analysis right now. But with relation to uranium, and looking purely at the uranium thesis, I am not at all worried.
You say sentiment is it, what did you say, 8?
Yes, it's very low.
What do you think moves it to back into the at least double digits from here? Like what has to happen? Is it just broad market related? Is it rate cuts? Is it something else?
I think between 1 and 10, when we get that low in sentiment, it just needs to stop going down. And I know that's a tough ask given the price action we've seen over the past few weeks, but if it just stops going down and people are like, okay, at least the floor is not falling out of my investments more than it has done already, I think that's enough to get it back into the teens. But after that, you get into like a more low volume zone where you need some price action to push it back up to 20 to 30 to 40. And actually, contrary to popular belief, well, I do run a service called the Contrarian Codex. And it is very contrarian to bet on an asset when everybody hates it and people are throwing it out of the window. What you actually need for a more sustained rally, you need that sentiment to stay above 50, to stay above neutral, to then load it up and then go to 60, 70, 80, or whatever. You don't want to get too extended, but what you want to see is that people are cautiously optimistic, enthusiastic even about the sector, and that momentum can take hold. And I believe that we will get there, but first we need to get out of these slumps.
Well, yeah, I agree. But how do we do that? Like, how do we get out of the? Because it's always, it's always darkest before dawn. So how do we get out of the darkness?
We got a lot of darkness when finally the macro headwinds kind of subside. So what I think we need to see is we need to see the broad equities market look at the current macro environment and say, okay, we can price in more rate cuts than we perhaps expect. I think those rate cuts alone need to be managed very carefully, because if they're just going to say, okay, we're going to do an emergency 50 basis point or 75 basis point rate cut, the market is going to panic. We don't want that. They're going to blow stuff up. So I think we need a coordinated effort. We're going to need more US dollar liquidity to prevent the US Treasury markets from dysfunctioning more than it has already. I think it needs to be coordinated with other central banks as well, mainly Japan, which by some extent started this entire thing. So blame the Japanese central bank for this, and not the uranium investment thesis. But I believe it was yesterday or the day before that the Ministry of Finance and the Bank of Japan they went into kind of dialogue to say, okay, what are we going to do about this market volatility? And they came out of it saying, okay, we're not going to raise rates if the market is going to be this volatile / dysfunctional. And I think if we see a coordinated effort and we see ample US dollar liquidity and lower rates, I think that will be very good for commodities. I think we also, which has been kind of keeping a cap on commodities over the past few weeks and even the past few months, has been kind of that lingering fear of a recession, which has gotten worse after that job report that was posted a week ago or so ago. And if you look at it from a historical perspective, I pulled a data set. Actually, I pulled a data set for today's update on the Codex, which basically stated that most commodities, they go down as the recession fears kind of get up and running. Then as you get closer and closer to that 0-day point where a recession is confirmed, it then starts to consolidate sideways because a recession is now confirmed. Depending on the severity of it, we could go down a bit further, but on a normal, quote unquote, run-of-the-mill recession, you would normally see it then consolidate. And then even as the recession still goes on the way, you see commodities rally again. And that is historically how it went. And I believe that these recession fears, they are really making a bad situation worse for uranium, for even a bit gold, but particularly silver gold, for all intents and purposes, has served as some form of portfolio protection, even if the underlying equities have taken a relative hit. Oil, gas, all those things, they are really being put down, or really being kept down by these recession fears and further problems and liquidity problems in the broad equities market. But I think that too will pass. How long? Could be a month, could be 3 months. And that's why I kept highlighting why you need a strong and healthy cash position and no near-term leverage or options, because the name of the game here is to make it to the other side. If it lasts 1 month and you have a bunch of leverage on, maybe you can make it. But if it lasts 3 months and your portfolio gets blown up, you will not be able to benefit from what comes afterwards.
What else is making the bad things worse for uranium is the spot price, and the spot market inactivity over the summer has also been notable. If we're to believe the reports that we see, although obviously they're very obscure, they're not always to be trusted. What are you making of the spot price move there that we've seen over the recent months? Do you think it will take a higher spot price in order to come out of this in combination with the macro potential tailwinds that you're describing here?
I think so. I think the term market remains the most important factor to watch, and that has been ticking up consistently over the past, I won't say the past year, but the past few years. It has been, whether it ticked up by 150 or even 50 cents, it has been consistently going up. And the spot price, a lot of people were calling for, okay, this is the end of the bull market back in January, because it went to $106 and everybody was chasing it up and everybody was extremely bullish. But looking at it right now, it pulled back all the way to $82. And even though the entire broad equities market was taking a dump and the uranium equities are down 20, 30, maybe even 50%, the spot market price, it has held in there. It has held in there on very low volume. The term price has gone up 16% on almost historically low volume. I believe around 35 million pounds were contracted this year on 30 different transactions. And that is minimal volume for a lot of price action. And even in the spot market, I believe that in Q1 of this year, we saw between 9 and 11 million pounds being transacted. And that may sound like a lot, but for some context for everybody listening right now, that is the lowest amount since the bear market low in 2016. And even over the past couple of days, this was shared on Twitter as well, but we saw a $5 move on 800,000 pounds being traded. It has pulled back a bit now. That was also due to what I found out yesterday, due to a hedge fund selling 300,000 pounds, and because they were liquidating assets, which again, it happens when things go down and you need to have either you need to liquidate you need to liquidate assets either to raise capital or to just meet a margin call because you were too leveraged. Physical uranium can be one of the candidates because the price, for all intents and purposes, held in there very strongly. It's not going lower. I don't think it's not going lower than $80 because it's not going to go below the long-term price because that will be arbitraged almost immediately. And there are a bunch of buyers, both utilities as well as utilities. And for example, the Chinese, several traders are all interested and more than interested in buying those pounds around that 80, like high 70s, low $80 level. So I don't think we have much downside on the price of physical uranium, not in term, not in spot, barring some completely unforeseen either macro hit, but even that I struggle to see, or uranium hit, and that I struggle to see as well. So what we're looking at right now, for those worried about maybe more hedge funds flooding this market with hundreds of millions of pounds because they're all being liquidated or whatever, according to my estimations, we are looking at around 15, maximum 20 million pounds being held by hedge funds outside of Sprott. And I don't see those being liquidated anytime soon in any meaningful amount. And even if they were all thrown on the market at once, of course, that would suppress price. But given that that's likely not going to happen and that we're watching a cumulative supply deficit of around 30, if you're very conservative, to 50, if you're very optimistic, million pounds a year into the 2030s. Yeah, I think we have a lot more upside left once we are done churning through this price action.
The velocity in the spot market also seems to be an important thing that is also particularly pronounced because of the seasonality in the uranium market. And so
Very true, yeah.
What we're seeing right now is actually notable in terms of velocity. Are you paying attention to what's happening with velocity?
I am looking at it, but I am also not surprised what you mentioned with regards to the summer months being relatively quiet. It is the same for the spot market, just like it's the same for the term market. It is usually relatively quiet and picks back up amongst like September, October. We saw this last year as well. It really picked up post-September. And I believe the WNA might have something to do with that because you could kind of at that point feel the energy in the room where people were talking about, okay, the price might actually start going up and there might not be as much supply out there as people are actually hoping for. I will actually be attending the WNA this year as well to report on it and to, again, see if it will have any effect on the market going forward. I believe that it will. Contingent, of course, on other macro headwinds. But yeah, I think that once the summer months are kind of passing by, we get into the September, October timeframe, I believe that velocity and volumes in the spot market and the term market will start to pick back up. And with regards to, just as a segue to the term market, a lot of people have been very, very surprised by US utilities' apparent unwillingness to step into the term market. But that was, in my opinion, mostly due to several factors, with the main ones being they are in the middle of trying to figure out the waiver process. There has been a back and forth between the Department of Energy and utilities and 10X to see, okay, can we get a waiver? If we get a waiver, for how many pounds will it be? And that kind of unclarity on this, I believe, has caused them to just sit back, assess the situation, and go from there. I will also say that what I've heard from a recent conference in Atlanta is that some utilities were convinced that this entire price rise was not sustainable and that the price would be coming back down before long. I think that they need to get used to the fact that we are facing a structural supply deficit and a structural elevated price environment. And those utilities and those people that are still working with supply side models that say, okay, at $55 uranium for any prolonged period of time beyond 1 or 1.5 years, we are getting more than enough supply online. Don't worry, price will come back down. I think they will be revisiting those models right now. They will be asking a lot of questions. I think once they're kind of used to that, and once the panic has subsided, and once price is a little bit more stable, I think that we will see more contracting. I think we will see more market activity. And that is when things will pick back up as that price discovery continues to go upward and to the right, as it has done for the better part of 4 years.
Well, but weirdness in the term market is also maybe not weird right now because of because there's a lot of, and there's another weird for you, but there's a lot of weird things happening in the world at the same time. There's the US banning Russian uranium.
Yeah.
There's Niger and whatever's happening there. There's transporting issues in Kazakhstan. There's a sulfuric acid issue, as we know. There's stuff happening in the Middle West. It's a special year in the US. All these things are kind of combining toward, so they're pointing towards there being weirdness in the long term market. What do you see there? How do you think the shape of the long term market is going to be in the near future before these things get resolved?
Before these things get resolved,
Yeah.
I think that we are going to see the majority of term market action coming from outside of the US and outside of Europe. As the Chinese, the Indians, the Russians, they're all going in for pounds. Um, Other, mostly Asia now that I think about it. I think the United Arab Emirates will be looking for more pounds. I've spoken to Stephen Roman actually yesterday. I uploaded that interview immediately afterwards because it was a very interesting chat about the current state of Niger. And he noted that Turkey's delegation also visited the Dasaman because they are looking for pounds. So I think that they will go in first. And after that, I think the Europeans and the US utilities will follow. After that, in a longer term, the weirdness that you described, I think that's a very kind way to put it because I put it at just volatile geopolitical environment. It is ridiculous what we're watching almost. And on the uranium front specifically, I just mentioned Niger. We saw the Imuraran mine license be pulled from Orano. Now, I will say that I didn't really see Imuraran being coming into production anyway in the coming few years because there's a 0.06 grade uranium oxide at like 130 meters depth, with like a high percentage of lime carbonate mix in. So it's not really economic. But again, if price goes to 150, it's a huge deposit. At some point, if you need a pounds, you need the pounds. But with that mining license being pulled, I don't fear that the same will happen to Global Atomic, for example, but the same happens to GoviEx. And that is putting in a risk. I think that the Chinese and Russian influence there should also not be underestimated. In other countries, I think Jabiluka, if I pronounce that correctly, in Australia, that's a 307 million pound deposit. That's also saw the mining license being pulled. And to be fair, I think if Australia can become a little more pro-nuclear, because they've been almost religiously anti-nuclear, they can become a little bit more pro-nuclear, or if the US or another Western ally comes to them and says, all right, you guys, you floating island over there filled with mineral resources, we need uranium. You have by far the largest uranium reserves in the entire world, beyond Kazakhstan, beyond Uzbekistan, beyond whatever other nation you want to call. Australia has the biggest amount of uranium in the ground. They could become a big source of uranium. And unlike Jabolika, like not every uranium deposit will be surrounded by the Kaduka National Park. And not every, because there is a lot of empty space in Australia, there will be plenty of uranium deposits that can also be found and developed in other spaces. They have some very good uranium deposits. Of course, they have Olympic Dam, but there are more there as well. And I think Australia could play an important role. I think Namibia could play an important role. But beyond that, I think that we will see a continued bifurcation in this market. And I think one of the things that will also mark this bifurcation is by the way that the fuel cycle is structured. So over the past few decades, the fuel cycle has, of course, been very centric towards partly towards Russia, partly towards the US. There are some facilities in France and the Netherlands as well, but it was kind of intertwined and people could always rely on each other. Like, for example, the Russians, they have never missed a single delivery of nuclear fuel. But if we're really going to see a more bifurcated market where Russia is going to be supplying the East, then the West needs to really start considering the fact that we need a secure domestic, or at least secure Western supply chain. And that's what we're seeing billions of dollars being freed up for. Right now, we're seeing in the US proposed capacity increases for enrichment and conversion. We're seeing the same in the Netherlands. We're seeing the same in France. We're seeing the same in UK. And it feels like they are finally taking this seriously, like post COP28, when they committed to saying, okay, we need a lot more nuclear power. Well, if you're going to need a lot more nuclear power, you need to be self-sufficient when it comes to nuclear fuel. if one of your biggest quote unquote adversaries on this geopolitical theater could cut you off at any time. And I discussed this before on other interviews as well. And it is quite ridiculous when you look at the quote unquote rounding error that the export of nuclear fuel is for Russia. So what we're looking at, I believe last year was around $2 billion for enriched U-235, plutonium alloys, and some other nuclear fuel related services. So $2 billion worth of exports. I mean, oil was 133 billion. Petroleum gas was 71.5 billion. Non-fillet frozen fish exports were 3.8 billion, almost double those of the nuclear services they provided in the form of that enriched uranium they export. So if at any point they're like, it's nice that you have those waivers. Well done, congratulations on all the due diligence and all the processes you went through to get those, but we are not going to supply you with any more uranium. That is something that could happen. That's not my base case scenario, but it's something to take into account. And I think that the West is slowly realizing that they need to be able to supply nuclear fuel to what is a huge part of their low carbon and reliable energy grid.
What do you think that results in over the long run on the supply side? Because we're talking a lot about the demand side here, but I'm also thinking about, is there going to be sort of a beacon of hope where we get a new stable supplier of uranium that maybe we're not thinking or talking about here, like Uzbekistan or something that is maybe obscure now, it's on nobody's radar, but could bear fruits if you see it, upfront enough?
Uzbekistan is certainly an option. They do not have the same reserves nor production capacity that Kazatomprom has, or Kazakhstan in general, but they pledged to double their production. Back when we first met in real life at Mines and Money in London, which was a great event, I also spoke to Navoy Mining, and they know that, okay, we're going to try to double production. I talked with them about their reserves, about their mineralized source uranium, what they needed, what they were planning to do. And then several months ago, maybe even a year ago, I can't really recall it exactly, but they came back on that promise and they were saying, okay, maybe not 2x, maybe 1.5. So they are already pulling that back a little bit. We talked about Australia. I think they could become a significant player. The US has some idle mines because they were at nearly 0 million pounds of uranium production over the past few years, and they can ramp up some production. We have some idle assets, but Antonio, even like you spoke to Mike Alkin, for those listening, and he rightly stated you can throw the kitchen sink at this thing. You can bring all these mines online. A few greenfield projects, just sprinkle them in there, be relatively conservative with your demand outlook, and you are still looking at a supply-demand deficit. So we're going to need more. So I think that if you're looking at ways to secure new pounds of uranium, you're quickly going to get beyond that traditional, okay, we're going to need more brownfield back online, we're going to need more greenfield. I think that uranium extraction from phosphate tailings from, for example, Morocco is an option for a few million pounds a year, 3 to 5, maybe even a little bit more. That is something that could add to it. Seawater extraction is right now something more of a lab thing, very small scale. But if the price is high enough, Antonio, we humans are very price insensitive, and we can be very creative if we have monetary incentive for it. So I think at some point that could play a role, but not for many years. I think phosphate tail extraction is a little bit closer. But again, more details need to follow on that, and I'm still doing research on that as well. So I can really speak to it any more than I already did. Maybe more uranium production from polymetallic mine deposits, but again, that is also very difficult to scale. But when people talk to me about like these massive deposits, and I always joke about like, oh, we don't have a supply demand deficit because Sweden over there, they have 2.1 billion pounds. And as like a sick irony may have it, there are 2.1 billion pounds that are uncontracted between now and the 2040s. So anyone looking at uranium right now and saying, okay, bring those two deposits online and we're good, we're golden. well, that's not really how it works, because if you actually look at the mineralization of those deposits, what you're essentially looking at, like somebody pointed this out on Twitter as well, it's just a sort of radioactive mud. It is very, very low grade. It's a black shale deposit, and it is like this alum shale it's so hard to extract, and it also doesn't help that it's very close to these villages that probably don't really want to have that massive deposit to rip apart everything around them. So I don't think that's realistic. I think there are other realistic deposits that will come more into the picture at, let's say, $100, 120, 150, name your number. But that takes time. And I think that one of the things that not enough people talk about is Cameco, in their conference call, they noted that they are ahead of schedule. They want Cigar Lake and McArthur River at around 18 million pounds, respectively, to get into production this year. And they're ahead of schedule, but they are ahead of schedule because they know what they're doing. Kazatomprom also knows what they're doing. They're facing some of their own issues with their sulfuric acid and a few other supply chain issues, but they also know what they're doing. I think I can count on two handfuls the amount of players in this market that they know what they're doing. And beyond that, there is such a drought of intellectual capital, of people that actually know how to build a uranium mine. I spoke to Ben Feingold in like a 1.5 hour excellent interview that I posted on the Codex last month. It has proven to be very useful up until now. And I think it will be proved to be very useful beyond that as well, because he also mentioned with regards to intellectual capital that so many people, they left the sector during this bear market and they left it to other minerals such as nickel, cobalt, oil and gas. And they are unlikely to really come back until they get a monetary incentive to do so. A lot of people are retired as well. So this complete lack of intellectual capital, I think it will really put a damper on the speed at which we will see an adequate supply response.
And that is within the new suppliers of uranium, if you will, that we're going to see a damper. But what about the existing ones? I mean, we have Cameco and Kazatomprom just very recently coming out with guidance. We know that the Kazatomprom guidance has been a bit of hopium, if you will, for a long time now, where they're just hoping to produce way more than what they realistically could. What do you think of there? I mean, do you think Cameco and Kazatomprom are being too aggressive with their predictions or outlooks for supply?
I think Cameco is in line with expectations. I think they will deliver on that front. I do not have a strong opinion on the quickness of their supply response once they get to their tier 2 production. But we will cross that bridge when we get to it. They first need to contract all their tier 1 production. They went from, I believe, 28 million pounds a year of their contracting book to 29 million pounds a year. I think with Kazatomprom, we will need to see more evidence with regards to them being able to secure adequate sulfuric acid. Their sulfuric acid plant that they wanted to build has been delayed a bit. But that will come online at some point, and at some point they will hold on that value over volume, but they will get more volume as well. But like these two, even though they are by far the two biggest players in this market, or at least two biggest publicly traded players, I think that they can deliver, but just them won't be enough, Antonio. Like Kazatomprom will not be enough, and they start to roll off as well into the 2030s. They themselves have said that we need 1 or 2 more Kazatomproms, and they themselves also said that there may not be enough guaranteed supply for everyone. Every time I say that, I sound a bit like a broken record, but it's because those two things, they were so true. And when they come from, imagine Saudi Aramco saying something like that. And on a relative basis, Kazatomprom has a much bigger market share. So I think they are right in line with what I expect from them, barring some unforeseen circumstance. But beyond that, I agree with both of them that when they were saying that these smaller producers, they will be facing issues. Like, for example, Kazatomprom, the notoriously most low cost producer in the world, they faced in the past 2 years a 60% increase in cost. Now, I need to caveat that by saying that this is 60% cost increase, not from a $50 per pound basis. No, this went from like cash costs of between 9 and 11.50 going up 60%, putting their all-in sustaining costs into high teens, low 20s. I need to recalculate that probably beyond that 60% for that Met tax policy that they talked about. So
Hmm.
looking at the tax policy, I think it was 6% right now, just flat line. It goes to 9% next year. And beyond that, from 2026 onward, if I recall correctly, it goes into 4% for 500 tons of uranium production as a single asset, 6%, so already at 6% for 1,000 tons, and then 3% increase in intervals of every 1,000 tons that you produce at a single asset to 4,000 tons or above. That caps you at around 18%. But wait, gets even better. You also get a fun additional tax credit or tax credit, taxation on your deposit at 0.5% for every $10 above 70, capping out at 2.5% of additional tax at $110 per pound or more. So if my bullish outlook for the price of uranium goes to where I expect it to, I think we will reach that 2.5% of additional taxes on all deposits, because that's not capped by production. So that is all going to translate into contracts. It's going to push up the global supply curve or global price curve for supply, because if the cheapest pounds in the world are going up by 60% plus that tax policy over the coming few years, and I don't see that price increase stopping anytime soon, I think that we are facing a lot higher prices for a lot longer.
You also just spoke to Ben from Ocean Wall on the Codex. Is that kind of among the lines of what he's thinking as well? Based on, I know he goes into the nitty gritty on Kazakhstan. I have to talk to him again. By the way, I spoke to him a couple of months ago, but I have to have him back on to talk about Kazakhstan. But what's he telling you about Kazakhstan?
Beyond what we already discussed,
Yeah.
he also noted that for next year he expects around, I believe, around 16 million pounds being produced. And like looking at, it's talking about tons, because that's what I have in my model as well. I think we're looking at around 25,300 tons for next year. It may sound like a lot, and it is an increase. But Antonio, like a few years ago, when you look at the graphs, if you pull that data from what they expected back then, they expected 31,000 tons of uranium production next year. So they are still, I believe, 6,700 tons below that, or 5,700 tons below what they were actually trying to produce.
Hmm.
So yeah, they are below that. I don't think they will be able to meaningfully increase production anytime soon, as we get into the kind of like that supply demand crux, that gap into the 2025, 2026, 2027, 2028 timeframe, and even beyond the 2030s as well. So yeah, I think that is the general expectations, what I discussed with Ben as well. I also wonder about the transportation routes. Of course, through Russia is kind of difficult right now. You're looking at the Trans-Caspian route, which is a lot more expensive, also subject to geopolitical tensions, for example, between Armenia and Azerbaijan. If we see any sort of tensions, escalation there, and any sort of armed conflict, God forbid, I don't want to see any of that. I don't care about the thesis if it means cost human lives. But
Hmm.
if we see any sort of conflict there, the biggest rail line where that uranium is transported through, like over the Caspian Sea, arriving in Azerbaijan, going over the railroad into Georgia and then into the Black Sea. That railroad is 30 kilometers from the Armenian border at the closest point. So critical infrastructure doesn't tend to do really well in armed conflicts. So I hope we don't get there. But this entire picture, it is not getting any easier. And I think that we will need to see the West really sort of grapple with the fact that, hey, maybe we don't want to be dependent on a Kazatomprom that is selling more and more of its supply to Russia and China and facing more and more issues of themselves as well. So I think that's a trend that we will see continue. And I think that we will need to see US and European utilities come into the market in due course. They have given themselves some rope by buying Chinese UP, by pulling forward some Russian supply, by flexing up legacy contracts. But once you pull one of those levers, it is pulled. Like, you can't flip it back up and then come back the next day and say, oh, there's another £1 million here. No, that's not how it works. So I think that that is finite and they will come to the market in due course. And from what I've been hearing from industry contacts, some of these industry participants are already looking for supply into the late 2030s, even early 2040s.
Something else that we seem not to want to rely on as these things are happening are also is also intermittent energy. And
Yeah.
I suppose that's also bullish on our side where nuclear is kind of growing. What are you, yeah, what are you seeing there? What are the sort of the biggest developments in nuclear now? I try to follow up with it, but at a certain point, like it's gotten to a point where we're getting new announcements and new bullish stories, or as many new bullish stories a day as we used to, maybe a month when I first started getting into the sector. So I think I've lost track of everything that's going on. What are you paying the most attention to now?
No, it's pretty incredible the way that nuclear power has gotten just the sheer amount of political, monetary, public, institutional support, all of those things. Like it is more than I could have ever dreamt of when I first got into the sector. Back then it was hated or just I call it aggressively ignored. But right now it is becoming even more loved by some people as well. But even like those people that hated it before, they're becoming more neutral to it because they're seeing that intermittent sources, they cannot adequately decarbonize a grid. As we've seen with Germany, like I had this discussion a million times with people that are saying, but no, no, we installed so much wind and so much solar and we shut down the best nuclear power plants in the world. They leave out that part, but we shut down nuclear power. We don't need because our coal use is down as well. Overlay, just if you want to have some fun, if this is fun in my book. This might not be fun in your book, but I have a lot of fun with this. Like if you overlay like the coal consumption, which is going down, I will give them that, with their industrial capacity as well, which surprise, surprise is also going down because you can't run heavy industry on solar and wind. It is it is a fun experiment to see how it would go. And I think France, on the other side of the coin, they have not been great stewards of their nuclear power plants, but like these Olympics, they are powered by a lot of low carbon nuclear energy in the country. And they have been an example of how to run a proper energy grid. If you have nuclear power, they could do a little bit of a better job. But with nuclear power in that grid, they've done a great job so far. Right now, we are looking at, I believe, 60 reactors being under construction, 110 reactors being planned for, and 7 reactors this year, which will add around 7.3 gigawatts. So if you model in between 450,000 to 500,000 pounds of uranium consumption per 1 gigawatt traditional reactor, that is a lot more demand that will stay in place for the coming, say, 80 years. For Western reactors, looking at where TIL's assays are right now, going into from the midpoint tens to low point twos into the point threes, you could up that estimate to around 600 to 650,000 pounds per 1 gigawatt reactor. So that adds a lot of demand for that same reactor. But beyond new builds, I think the most important thing, Antonio, and for everyone listening right now, it's just life extension because it shows the amount of public support we're seeing. And I don't think we're going to see any more, barring a real problem at the reactor. I don't think we're going to see any more premature closures of nuclear power plants. And that has been reflected in recent surveys by US utilities as well, who almost unilaterally mentioned that they believe that they will be running their reactors for 80 plus years, where a few years ago they were like, okay, 40 to 60 years, maybe, but 80 years, probably not. Right now, they are getting that confidence, they're getting that monetary support, they're getting that political support, they're getting that public support more than they perhaps could have ever have hoped for, to keep their reactors running to that 80 plus year life cycle. And I think one thing that helps as well is the fact that we are looking at a data center revolution. So what we're looking at is between, in the US in particular, because they will be a front runner, between 30 and 40 gigawatts of nuclear power, of power needed for these data centers by 2030. So that is a lot when you consider one data center use about 200 to 300 watts per square meter of power usage. And what do these data center wants with these tech giants? They want reliable power and they want to boost their ESG numbers. And how do you do that? You get low carbon nuclear power. And after these nuclear power plants have dealt with so many problems and people not really liking them, if a data center comes to you, or like a tech giant with the data center comes to you and say, we signed a long-term contract, we want to pay a premium for your nuclear power. You're not going to shut down your nuclear power plants. You're going to sign that contract. You're going to take that money. You're going to supply them with their power. So I think that we're not going to see a lot more shutdowns. I think we're going to see a lot more announcements for a lot more nuclear power staying in place for longer than we first expected. That will need to be modeled in as well. And I think that contrary to popular belief, we're going to see a lot more new builds in the West, whether that be SMRs or classic in the US APR 1000s or other reactor designs in Western Europe. I think we're going to see a lot more. I think that 60 under construction number is going to grow. And this outlook, at the risk of sounding like a broken record, as I mentioned earlier, this outlook is absolutely incredible.
So you don't have to correct yourself. You said 50 gigawatts of nuclear power is what they need. And then you corrected yourself to saying it's 50 gigawatts of power. No, they actually do need the nuclear power because that's pretty much the only option. It's the only makes sense option. It's not cheap. It's not without risk. It's not without issues. It's not without cost. There's challenges, but everything else is just so nonsensical that
Yeah.
really they need 50 gigawatts of nuclear power, just like you said.
So we
So
get
that is
fusion, which is probably like another 50 years. It was 50 years away 50 years ago. It's probably another 30 to 50 years away now. So not really a thesis breaker.
I like I like technological developments and stuff like that, but I'm not. I used to be way more bullish on them when I was younger. I think 5 or 6 years ago, I would have believed more the whole case for fusion and even for hydrogen and whatnot. I was actually bullish on hydrogen for a while.
Fair enough. We've all been there.
We've all made mistakes. What do you think? This whole picture that you're painting here, Mart, it is bullish to put it mildly, but it's different than what you've painted or what we've talked about in the past and over the last couple of years. It changes all the time. It evolves all the time. What do you think performs best during this part of the bull market, this segment of the bull market? I feel like what you don't have to give me specific names. I know you do that on the codex. So for people listening, there's going to be a link if you want to see what Mark works on. You can see it on that link below. But what do you think outperforms? Like, what subset of the market is it? Explorers? Is it developers? Do we still need the producers? And then where I'm coming from with that question is because I'd published a meme a while back as something along the lines of saying I could have just bought Cameco and chill when I found uranium in 2018 and I would have hit it out of the park. But instead of I kind of over engineered my portfolio with many companies that turned out to have moose pastures and then needed to dilute and yada yada yada. Therefore, at the time when I published that, was still down on my portfolio, even having found uranium right on time. So I was right on timing. I was writing a thesis and I lost money, right? And so what is the Cameco of this segment of the market? Like what's going to outperform going forward?
I would say that looking at this, your meme is not wrong because at the start of the bull market, what usually performs best is the physical metal. And beyond that, the biggest producers. That is where it starts with. If you extrapolate the data for stock market performance for these underlying equities for a lot, and I mean a lot of commodity cycles, intermediate commodity cycles for individual commodities, but also just general commodity super bulls, if you call it like the super cycles. Let's call it that. That's a term most people will be familiar with. I believe we will see one of the next few years, but that's another discussion for another time. But if you look at how usually the underlying equities perform, it starts with the big boys, the really big producers, the underlying commodity itself, and then it starts trickling into the high quality and most liquid developers. So we're seeing companies like NextGen, Denison Mines, they've done very well, and those like the smaller cap producers and those high quality developers, they got these fund flows. They are the most liquid. They got some ETF flows as well. And now that we are in the middle to 2/3 of this bull market, I think the middle is a more accurate representation. We're slowly going to start getting into that, seeing that that capital flow going into the smaller cap developers, into the explorers. Again, contingent on them actually being quality developers, because even though a rising tide may raise all boats, some boats have leaks or bad captains or anything or both or anything else. And some boats will be a lot better. So I think that we will see continued capital flows going to the biggest and best names in the sector. I think those will hold up the best as well during correction times. But at some point, when speculation returns and when spot is stacking again, and when everybody and their goldfish wants to have some form of uranium exposure, and once the sentiment indicator is getting into the 80s and the 90s and the 90s to 100s, once again, I think that is when you will see the smaller caps outperform as well. But we will cross that bridge when we get to it. And I think it's important to construct your portfolio in a way that you can capture that upside, that torque, if you will, on these quality exploration and development names, but that you also have a basis. Like I call it a pyramid approach. You want that foundation of those really strong companies, perhaps a bit of physical, depending on your risk tolerance, your portfolio strategy. And then you build it up with more leverage as you go to the top, because that's a small part of the pyramid. You could build the pyramid upside down, but they might go well if the market goes absolutely parabolic, but usually like these upside down periods, they don't tend to stand for a long period of time.
Yeah, I have comparable thoughts, although I still think that starting bottom up, and that's kind of what changed for me since those portfolio changes as well, is starting bottom up as opposed to top down. As in, like, I understand the uranium thesis, but I now care a whole lot more about it there being a good asset with a good management team, trading at a fair valuation that's not over pumped or over promised, to put it mildly. So that's important to me.
Yeah, fair enough. I agree. I think that it's very important that if you invest in a uranium company, that you talk to the management, you do your work on the asset, and you really carefully consider if they're selling you a dream or if they're selling you actually something that will get a lot of value over the course of this bull market. I noticed that I spoke to Stephen Roman yesterday, and I don't really like to talk about individual names on these interviews, but I will say that I have a lot of faith in Global Atomic. Yes, the jurisdictional risk is very apparent, but Stephen, he is a shareholder himself, which again, if management eats their own cooking, that's a very good sign. He bought more shares recently. He's trying his damnness to get this thing into production to make sure that he can produce shareholder value. And you can see that how even in a challenging jurisdictional environment, a great asset with a great management team, they can still create value. Yes, they've taken a hit recently, but I back them to create more value going forward. And I think that for everybody listening right now, reach out to these companies, talk to management, ask the tough questions. And if you're happy with what they're saying, I think you can sleep a lot better knowing that your capital is being stewarded in a right way, rather than if you're sleeping thinking about, okay, what the hell are they going to be spending my capital on now?
That's one thing that I also always ask about, and one of my favorite questions actually is how much of your own net worth have you invested in this company? Like, how important is it to you? Because people always talk about skin in the game, and they're like, oh, I have that many shares, but how did you really get it? How important are they to you? So that's something I ask as well. That's actually probably a podcast in and of itself, Mart. I do know we're coming up on time here, though, and this has been a good conversation already. What am I forgetting to ask you about, what did you come here hoping to talk about that I'm failing to bring up?
I think we talked about a lot. You always ask a very nice question. I always like watching your channels for that, so I think it's a good thing. I think maybe a little bit more color on contracting for those worried about contracting price kind of stalling out because of inadequate market activity. Over the past few years, we saw a lot more RFPs enter the market that kind of started moving price. We saw the Diablo Canyon, we saw the South Koreans. Those RFPs were talked about a lot. We're right now seeing utilities coming to producers more directly in order to not kind of startle the market or to have more quote unquote private conversations. But from what I've been hearing from these private conversations, we're already looking at floors being negotiated for in this price range, so that $70 to $80 level, ceilings going into $130 if there even is a ceiling. I've even heard about some contracts having no ceiling. So if you look at the way that these terms are being put into these contracts, if you look at flex options in contracts that are being negotiated for new contracts from what I've heard, of course, I don't have a vision on every single contract that is signed because a lot of these are very private, have NDRs attached to them. But from what I've been hearing, this development in the way that these contracts are structured really indicates that we are in a seller's market, that producers are having a bigger say at the table than they had even a few years ago, or especially over the the bear market post Fukushima. So that is a very good sign. These terms are improving, and I think that once we see more utilities enter the market, that we will see more price discovery. Again, as I mentioned earlier, we've seen a 16% raise in the price over the past year on 35 million pounds over 30 contracts being contracted for. So I think that's a very good sign. We saw I believe 0 term market transactions in June. We saw one last month for 3.2 million pounds, something like that, in a single transaction, but nothing more than that. And I think it will pick back up post the WNA. Again, I will be attending and I will be reporting on it accordingly. And given everything that's happening, even though the price action of the underlying equities might not reflect it, I think that we are due for a very, very interesting 6 to 18 to 24 months for uranium. Again, I know that right now the people listening, they're very frustrated with price action, and I don't blame you. It's been very volatile. And with all these fundamentals that we discussed today, shouldn't the price be higher? Yes, under normal circumstances, it should be, but macro indicators, they do what they do. And again, I report on those every 2 weeks. And I'll be keeping a close eye on it. But again, I will end this interview just the way that I started it. I am not at all whatsoever worried about the uranium thesis going forward.
Got it. Good, Mart. Yeah, I'm yet to get an update from Stephen, as I mentioned, maybe at the beginning myself, hopefully in a few months' time. But for now, people can go on Patreon and watch your interview with him, Mart. Thanks again for doing this. Appreciate it. I'll let you drop off now. I know you have to go. You have a life to get to. But I'll be moving into my favorite part of this Transition Talks episode, with that being, of course, the CEO barbecue, where I have 2 uranium CEOs to grill, but not before my absolute favorite part of any episode, which is, of course, the disclaimer. There's a warning on your screen right now. As I always like saying, you're obligated to read it, but you're also advised to read it. And this is the first and the last time in this program that you're going to be advised to do something, and it's going to be to read the disclaimer. Because this is not just some disclaimer that's obligatory and just up there for sakes, for just so it's up there. This is an actual warning that will help you not lose money. And that's, by the way, money is, of course, part of it. I always like saying that as well. I am here to make money. I make money because this channel exists. I get compensated for the time that it takes me to produce these interviews by some of the companies that you're going to see mentioned on here. Most of them actually don't pay for it. Which I hope is going to change in the future. But I would like to be aware of the fact that some of the companies you're going to see in this episode have paid for the production of these interviews. In this episode specifically, it is Skyharbour Uranium. They are a paying client of Resource Talks, and you should know that. But even the companies that are not paying, that you see on this channel, again, which is most of the companies don't pay, and in this episode, Premier American Uranium has not paid to be included in this program, but they're still likely seeing their participation in this episode as a chance to do marketing. So you need to understand that, but you also just need to understand that any company communication material that you're going to find out there is going to be marketing. It could be interviews, it could be other people talking about the stock, it could be their presentation, their Twitter account, it could be their website or LinkedIn account, their mailing list, whatever it might be. That's all marketing. And you should know and understand that and approach it as marketing. And although I don't make buy or sell recommendations, because there's, in my opinion, a clear conflict of interest to take money from a company and then go and tell a bunch of people to buy that stock, many people out there will do that. And so you should be aware that that happens. And anytime you hear or read something about a public company publicly online, you should know that that's marketing. You should know that there is a bias in there, because it's not always going to be clearly disclosed. So just assume that everything you consume is marketing and approach it with a dose of skepticism. And although I might try to be different than other interview providers by looking into more than just the front page of the company's website and asking the CEO where the projects are located, And unlike most, I don't give the companies the questions up front. Unlike most, there are no questions off the table with resource talks. And unlike most, the companies get no say in what ends up in the final video. They get no editing rights over these episodes. These things should still be looked at as advertisements, though, and not as research, and least of all as recommendations. Unfortunately, for me, for you, for my wife, I'm not a magician. I don't possess any superior knowledge. I have no idea what's going to go up. I don't even know what's going to go in circles, even if it did. I have no idea what's going to go down either, right? So there's never guarantees in these episodes. So I'm making no guarantees here besides one. As I said, there's one piece of advice, and that was to read the disclaimer. And there's one guarantee, and that guarantee is that there's going to be forward-looking statements in these conversations that you're about to watch. And those are going to be conversations that are general and impersonal in nature, containing hopes for the future, or for future events that may or may not take place, depending on many different factors, both within and outside of a company's control. So I want you to know that. I want you to be aware of the fact there's risk to investing as a whole, but there's definitely an increased risk of investing in the mining industry. This is a venture capital business, so it carries higher risk. Therefore, you should talk to a professional investment advisor, as well as just do more research. Not more. This is, as I said, this is not research. Just do research, which means doing more than just watching this video before taking any decisions. And you can do that on setterplus.ca. That's an official government website where you're going to find the official filings from the companies. You're going to find their financial reports, their management discussion and analysis. And you're also going to find a management information circular that is going to tell you how much money your CEO is making, which is always interesting to see. There are disclaimers on your screen, as I said, have been disclaimers on your screen. There's probably one on your screen right now as of still. If you don't enjoy losing money, read it and be careful out there. But all that said, though, I'm going to start shutting up, and I am going to be on my way to the Athabasca Basin, which is, of course, in Canada, northern Saskatchewan in particular, for an update on Skyharbour uranium from Jordan Trimble, the company's CEO. And I've done many interviews with Jordan over the years, really, that we've been talking here. So no need for a fancy introduction. But I suppose in a nutshell, Skyharbour, what you need to understand about Skyharbour is that, number one, this is not your typical uranium explorer. This is a hybrid uranium company, is what they like calling it. They're an explorer as well, but they're an explorer as well as a prospect generator at the same time, which does help them. I think the last time they raised capital was in 2020, so it helps them potentially keep dilution lower. They're listed as SYH on the Ventures Exchange in Canada, and with about 182 million shares outstanding and a $61 million market cap at the time of recording of this. This is a 33-cent stock. This is actually where I'd like to kick it off, Jordan, because you and I spoke, I believe 2 months ago, or maybe 3 months ago, something along those lines. And you've had 6 news releases since then. You haven't had to raise capital. In those news releases, there was partner advancements, as well as your own assay results that, by the way, included 7.3% uranium over 3 meters at Moore. You made a new discovery at Russell, which is close to Denison, and it was up to 3% grades at the Fork Zone over half a meter. But the market is not giving you much value for any of that, with your stock having fallen over 25% since we last spoke, which is actually not, as I mentioned at the beginning of the episode, not atypical, given that Uranium and URNG ETFs are actually down. Both of them are down more than your stock. But what's going on? What do you think the market is missing here?
Well, I mean, look, as we discussed offline, obviously there's, external factors that we've seen, basically wipe out a lot of value across the board, and in particular with uranium equities, and we're obviously caught up in that. It's not unusual given the time of year. There is a seasonality at play. We've seen this the last handful of years, and it's provided for very, very good entry points for people looking to investors looking to build positions or average down. I've been purchasing shares in the open market, as you'll see with my insider reporting. I just see there being incredible value here, given what we've got going on with the company and what we've been announcing. And getting back to the news more recently, we did see a bit of a pop on the news that was well received by the market, at least in the short term. But again, we then saw the kind of broader market sell off, and in particular the uranium sector get hit quite hard over the last, week and a half, 2 weeks. So, we'll see how things play out the rest of the summer. If you look at the charts, historical charts of some of the larger uranium mining companies, usually mid-August right through till the end of the year is the strongest period for these companies throughout the year. So again, there is a seasonality at work here that I think is worth noting. And yeah, look, I mean, it is, at the current market cap, like I said, there's incredible value proposition. The announcements that the news releases that we had over the last several weeks and in July, one in particular that announced a new discovery at our Russell Lake project. I mean, this is a major breakthrough for us at this project in terms of the discovery process. It's a multi-percent, up to 3% U3O8 intersection over a half a meter. That was within 2.5 meters of 0.72%. Drilled into a zone, a new discovery zone that had never been thoroughly tested or quite frankly tested at all, really. There was one historical drill hole a ways away that Rio drilled, but the first hole that we drilled that successfully intersected the conductor at this new target called the Fork target, intersected this high-grade mineralization in the sandstone, and relatively shallow at about 340 meters. So we can talk more about that. And then shortly thereafter, we did announce some high-grade notable results from our Moore Lake project, which as you're well aware and your audience is well aware, has been a flagship in the company, flagship project in the company since 2017. It's now a co-flagship project with the adjacent Russell Lake project, but some very good high-grade results, up to 7.3% over 3 meters. There was a half a meter of 15% within that, and it's relatively shallow. These are high-grade zones of mineralization that are predominantly hosted in the sandstone at what's called the main Maverick zone, and it's about 250 to 270 meters deep, and there is a lot of potential for expansion at this project, and in particular at the Maverick corridor. That's just one of several high-grade zones that do make up a resource. We are working on a resource estimate, which will come out later this year. We are planning to continue drilling there this summer. In fact, we're going to be starting back up in the next 30 days or so, another 2,000 to 3,000 meters at Moore Lake. And then following that, we're going to get right back to that new discovery at Russell Lake with another 4,000 to 5,000 meters. So a combined 7,000 to 8,000 meters across both the Russell and Moore Lake projects, fully funded and permitted. And that'll take us right through the remainder of the year. So yeah, I mean, obviously it's tough when the market is not responding the way you'd like, but it's not unprecedented. And I do believe we are going to see a very strong end to the year, not just driven by the news flow that we're going to generate, the catalysts that we potentially have coming up, but also I think there's going to be a move higher across the board with the uranium equities, and we can talk a lot more about that later on in this interview.
Well, I sure hope you're right about the broad market and the equities, and I hope YellowBull is right too. But I want to talk specifically about what's happening with Skyharbour, though, Jordan. What you've been drilling, and kicking off maybe with the new discovery at Russell. As I mentioned earlier, there's a new discovery here that came from your winter drill program, which was, by the way, over 5,000 meters that you drilled in total. It was spread over 2 phases, I believe, and 10 holes in total, with the first 6 already having been reported and thus containing that new discovery that's at the Fork target. And for people listening, that included 3% over half a meter at about 340 meters deep. So it's just above the unconformity in the sandstone. And again, obviously good grades, 3% is decent, but rather narrow, though, half a meter. What's your geological understanding on why it's as narrow as it is? And what do you think that means for future exploration? And how are you generally just, I don't know, looking at what came out at being high grade, but also narrow?
Well, look, I think it's important to emphasize this is the first hole drilled into that conductor. If you look at discovery holes from some of the largest discoveries and deposits in the basin, NextGen, you look at the discovery at Wheeler River at Phoenix, Rough Rider, fission at Triple R, right? The initial hole was not 10 meters at 10%, right? And so the biggest, most important, feature here or factor here is that, we have now identified high grade multi-percent uranium hosted in sandstone at the project that had not previously been discovered or known at the property. And so this is a big breakthrough. We think we've just scratched the surface to something much larger. We're going through and we've spent a lot of time. Our geological team has been hard at work on modeling this and predicting and putting together drill targets for this upcoming program that we think can deliver a much larger, wider zone of high-grade mineralization. We're seeing all the right indicator minerals. We're seeing all the right ingredients, if you will, for a much larger, higher-grade zone of uranium. So we're confident that we can deliver that now. But this is something, we haven't seen yet, nor any previous operator over the last 25, 30 years has seen yet at the project. And one of the reasons this new target was not drill tested historically is because it lies right under the power lines that go up to McArthur River. So there's the road, there's the power lines that run parallel to the road that service the McArthur River mine just up to the north from where we are. Our exploration camp at this project is right near this new discovery. So it really couldn't be a better place to be to have made a new discovery and then to be following that up, as it's very low cost drilling, and it's only about 4 kilometers south of the Phoenix deposit as well at Wheeler River. So again, location wise, this is it's excellent to have this new high grade zone of mineralization located where it is. And we've done a lot of work now, given that there was historically with the geophysics interference from those power lines. One of the main reasons that it was not thoroughly or properly tested previously. We've done a lot of work to again, model what we think is happening there. And that'll give us, with this upcoming drill program, our best shot at building on this new discovery and hopefully delivering on, again, a much wider zone of higher grade uranium mineralization that, again, will, I think, make a major difference in terms of our valuation. So that's something that's coming up in the next few months. Again, we're fully funded for that. And I think we have an incredible shot of delivering that. And just to take a step back too at this project, I mean, this is a big property. It's over 73,000 hectares. It's basically all of the ground in between the McArthur River mine and the project that is host to the mine. To the north, the Key Lake Mill, to the south west of Russell Lake. Again, that road, the haulage road, runs right up through our project. So we've got infrastructure there. Our drill costs are well below $350 Canadian all in a meter, which is significantly less than most exploration companies working on more remote projects. And again, our largest shareholder and strategic partner in Denison Mines is developing and building a mine just a few kilometers away at the Wheeler River project at the Phoenix deposit. And again, that deposit is just 4 kilometers to the north of this new discovery. So it's a very exciting new development. Again, I think the market is underappreciating it currently, but that can change very quickly.
The Denison thing, or your proximity to their deposit, is something that's definitely interesting and something I do want to touch upon. What really caught my eye here is what you mentioned in the news release here, that you talk about that there's an east to northeast and a north to northeast trending structures on the property, so where this new discovery is. And so with this new discovery, how does the mineralization relate to those structures? And maybe also, how important is it for you to do further structural analysis to better understand those trends?
Yeah, it's a great question. And getting back to the previous question as well with, where do we think there can be larger zones or wider zones of mineralization? Well, the simple answer to that is where you do have these cross-cutting structures and features that intersect or break up the main conductor, right? And so we've got this east-west trending conductor that, again, we had to do a lot of work on just to model these conductors, given they're right under the power lines, right? And there's interference with the historical EM data and signatures, but we've done that now. We've intersected the conductor. We know it's mineralized. And so now the goal is to go in there and find zones that have been broken up by these cross-cutting structures, and that's in a lot of cases they're north to south trending structures that would trend onto the Wheeler River project. And so there is there's a lot of similarities geologically. I mean, look, the most of the drill targets, including this drill target at the Russell Lake project, are the continuation of conductive corridors, fertile corridors from Denison's Wheeler River project, right? So you're seeing a lot of the same geology or similar geology. And in this case, we last year when we first started drilling Russell, keep in mind, this is only our second drill program at Russell Lake since acquiring it or optioning it from Rio Tinto back in 2022. Rio became a large shareholder and has remained a large shareholder of Skyharbour and a partner, but we optioned the project from them in 2022. We started drilling it in 2023, where most of the drilling was focused at what's called the Grayling target area, which has widespread mineralization, and that again is a target that is the continuation of conductors from Wheeler River onto our project. And we had some decent results, but not the high grade we were looking for. So we kind of changed things up going into this winter program where we just announced the results. And lo and behold, we tested this new target, which is related to that conductive corridor, the broader Grayling target area. But we obviously have identified a new conductive trend or corridor, and there's several conductors there that have the potential to host multi% higher grade mineralization. So yes, we are now going to go in with a better understanding of these cross-cutting structures and features and try to tap into something where there is the potential, again, for much larger, wider, higher grade zones of mineralization because the conductor's been broken up. And that's what this upcoming drill program, again, like I said, I think is going to deliver on.
That's going to be interesting to watch, especially kind of understanding the whole structure of that part of the land package, and why I'm maybe going a little bit more in depth on the nitty gritty on the geology here is because from what I could tell, and again, I'm not a geologist by any means, but I'm reading through this news release that I have here. And you provide a lot of background and plenty of geological information, by the way, so that's good for people watching and listening. If you're a geo, wherever, go read that. But so what I'm reading about, what I'm focusing on here is also various lithologies in this discovery. They're including graphitic politic gneisses and an Archean gneiss, as well as the assays that you reported don't only contain uranium, they also contain vanadium, nickel, and boron, and so on. And so I'm already starting to think that this might be a more complex system than what you might have thought previously, which could be good for mineralization. But what are your geos telling you about the complexity of this new discovery, as well as what the right way to approach it is in the future?
Yeah, I mean, look, having those are indicator minerals, right, of for high grade uranium deposition, and so having that complexity, as you refer to it, is a very good thing, right? So again, we're seeing all the right indicator minerals. We've got all the right geological ingredients here for a much higher grade, larger deposit. And interestingly, it's because again, a lot of you have your unconformity deposits. You can have deposits that lie just above that in the sandstone or below in the basement rocks. But the high grade that we've discovered here, at least thus far, in that one hole is sandstone hosted. A number of the mineralized zones at the Grayling target area, just over to the north and to the west, some of those are basement hosted, right? So we are, we're testing for both target types, but the sandstone hosted mineralization, obviously it's going to be a little more shallow given it's above the unconformity, but it's also interesting too, given, the potential down the road for ISR to be a mining method in the Athabasca Basin, as Denison's proposing to use at Phoenix. So, there's a lot of exciting features right now. It's still early days, obviously, with this discovery, but we're onto something here, and we're fully funded, fully permitted to go and thoroughly and properly test it with this upcoming program. And this from a market standpoint too, I'd say, it was unfortunate timing that we had this kind of good news when we did. Obviously, was the market was turning in the other direction. There wasn't a whole lot we could do about that, but that can change quickly again to the upside. And there is, as we discussed, a seasonality here. And I think that the news that comes out from this upcoming summer and fall program, could not come at a better time, given the, what I expect will happen with the sector over the next 6 months.
The ISR potential or similarities to Denison's project is a very interesting point, in my opinion. Whatever's happening, that's the thing that really made me go like, okay, I really have to understand this news release. Are there similarities in maybe the lithological or alteration package between what you've drilled and what Denison has been drilling or was drilling initially?
Well, it's too early really to comment on that right now. I mean, we know obviously it's sandstone hosted, so that's the first major checkbox. But the main focus for us right now is just to prove up as much as we can, as quickly as we can, and make this a legitimate new bona fide big high grade discovery, right? So after this program, I'll be able to, we'll have a lot more information on that. But the focus right now for us is to, go in there and do our best to expand on this initial discovery.
You do have 4 holes pending, as I mentioned. Assay spending on 4 holes. Where were those holes drilled relative to this new discovery?
Yeah, most of those were drilled at a different target called the M Zone extension, which was just up, again, continuation of conductors and structures from Denison's Wheeler River project, but a little ways further up to the north.
And you mentioned that in the upcoming program that you've already announced, you mentioned that it's going to be about 5,000 meters focused on Russell. Where is that going to be? Is that just going to be focused? All of it goes into Fork and you understanding this new discovery, or is it going to be a split still?
Yeah, so it'll be 4,500 to 5,000 meters. A good chunk of that will needless to say will be at Fork. We're going to go in, we're going to drill there initially. This program, the drilling at Russell, that is, will commence later in September once we've completed the initial few thousand meters of drilling in a summer program at Moore Lake. Russell, given the location of the various targets, they're just off the road. It's drillable all year round, and again, very inexpensive to drill. So we can drill basically right through October, November into the winter months, which is great. But I'd say right now the plan is for a bulk of that program to be focused at the Fork target area. There's 40 plus kilometers of prospective conductors in and around call it the western part of the project that's adjacent to Wheeler River. And again, this project is still at an exploration stage. It's not like there's a deposit there. So there's incredible discovery potential, not just at Fork, which we've hit at, but at some of these other targets as well. It was sporadically drilled by several previous operators. Not a lot of systematic and kind of closely knit drilling. It's been drilled with 400, 500, 600 meter drill fences. And so to go, and as you're well aware, you can find a lot of uranium in a relatively small strike length of 100 to 150 meters or even less than that. And so, we feel like we're the first operator that can come in with a lot of historical data at the project and go in and systematically drill test some of these higher priority targets to vector in on a new discovery. And I think, again, we're well on our way to doing that here with this new Fork Zone target.
Do you have a whole team naming these projects? You have a bunch of projects and a bunch of targets. Who's coming up with these names with the Fork target?
Yeah, we have our geological team based in Saskatoon, and we'll go through the naming process, if you will. But needless to say, the geological modeling and the drill picks are take priority over the naming of it. But look, when you've got over 580,000 hectares across 29 projects as we do, there's lots of different properties and targets, and we've as we've discussed, I mean, our business is dual pronged, right? We are an exploration and discovery company. Obviously, we just talked about Russell, and just one kind of final note too on Moore Lake, because Moore Lake is, I think it has been overshadowed a little bit by Russell, given, understandably so, given that we've done most of our drilling in the last couple of years at Russell. But Moore Lake is host to a shallow, high grade, several zones of high grade uranium mineralization, and it's a great asset in our project portfolio. This was the first this recent program that we just finished, where we announced some very high grade results. Every hole that we drilled at the main Maverick zone in that program intersected significant zones of uranium mineralization, likely expanded the resource. We got some better density readings as well for the resource estimate. And again, we're going to be following that up with more drilling here in the next month or two, continuing to expand those known high-grade zones of mineralization. But there's still good exploration potential along strike at Maverick, the Maverick corridor. It's 4.7-kilometer long conductive corridor and a depth in the underlying basement rocks. And there's regional targets as well at the project that could deliver new discoveries. So those two projects are the focus for us when we have our exploration cap on, the money that we raise and that we fund our direct exploration with. And they're side by side. Collectively, they're represent over 105,000 hectares of prime real estate south of McArthur River, northeast of the Key Lake Mill, and adjacent to Wheeler River. And both projects, again, there's a lot of blue sky potential at both. And we think that both of these projects are going to allow us to create a lot more shareholder value. Now, the other part of the business is the prospect generator business, and we've got a few dozen projects now as that make up that business, including 7 that are currently under either option or being optioned to partner companies, or 3 of which now that are formal joint ventures. So one with Orano, France's largest uranium mining and nuclear fuel company, and they've been carrying out a fair bit of exploration and work this year, including a big soil sampling, SGH soil sampling program that's coming up here, and some geophysics that they just recently completed. That's at the Preston project. And then you have Azincourt at our East Preston project. They're the majority holder of that project and the operator. They completed some drilling earlier this year. And then more recently, we formed a JV with an ASX-listed partner company, Thunderbird, previously Valor. And so they're now the majority interest holder at the Hook Lake project. But we have 4 other properties that are being advanced by partner companies under option agreements. And 2 of those companies, North Shore and Tisdale, recently completed winter drill programs. We're expecting additional work programs from them over the next 6 to 12 months. And so if you look at all of our current partners, the 7, you probably see at least 4, maybe 5 or 6 of those companies carrying out work over the next 6 to 12 months at those respective projects. So that generates a lot more news flow. We've discussed the benefits, the benefits of having this prospect generator business, cash that comes in, cash and shares that come in. We haven't had to raise a hard dollar since August of 2020. Big part of the reason for that is, being able to monetize some of these secondary projects. But, most importantly, it provides for more news flow and the opportunity to participate in new discoveries and exploration success in the Athabasca Basin. So shareholders of Skyharbour get exposure to these partner companies and projects through usually a minority interest that we'll retain in the project at the end of the option. Sometimes we'll have an NSR as well, and we try to maintain a large equity position in these various partner companies as well. So in total, these 7 current partners, the JVs and the options, represent potentially over 80 million in combined project consideration. So that's exploration funding as well as cash and share payments. Again, that's assuming that these companies all fully complete their earnings, but it's a significant amount of money that could come in to advance the projects, and some of that as well, obviously in cash and stock coming directly to Skyharbour. And we've got an inventory of another 20 plus projects, right? That we are in active negotiations on some of those to bring in new partners as well to build out that prospect generator business. So that's a big potential catalyst, as well as not just the news flow from the existing partners, but new partnerships and option agreements being signed with other new companies coming into the Athabasca Basin.
I do want to touch upon Moore Lake, but as you're saying, as you're telling me this about the partners and whatnot, it also just makes me go back to Russell and think about how that's going to develop over time. Has Denison taken note of what you've drilled there?
Yeah, no, absolutely. I mean, they're our largest corporate shareholder, right? Dave Cates, their president, CEO, is been a director of Skyharbour now for 8 years, and so yeah, we work as closely as we can with them. Their geological team knows that region, part of the basin, very, very well. So it's a huge benefit to have them as a strategic partner, given the work that we're doing at Russell.
Well, why I'm asking that is because I'm thinking, and I'm assuming to begin with, that eventually this part of the project should end up with them. Again, under the assumption that ISR works for them first, and then under the assumption that what you have is similar to what they have. Although, I mean, the proximity, conductors and whatnot that you just explained to me, it would make sense if it did, although, again, we don't know that yet. How far, though, do you think you're going to have to take this before Denison becomes more interested in discussing a potential transaction on Russell Lake?
Well, again, we're still at the discovery stage, right, with this project. I mean, the first things first. I mean, as I highlighted, the project is, it's had a fair bit of historical reconnaissance drilling, exploratory drilling, but no major discovery. So, that's the first step, right? And really, near term for us and our investors and potential investors is, this upcoming drill program, multiple drill programs, but at Russell in particular, it's about expanding this zone, right? We need to prove out this discovery, and again, we're confident that we can do that. It's this recent program, given it was only our second program to in drill testing a new target. I mean, there's lots of well-known targets at the project, but this was this was a new target that hadn't had much of any previous drilling. So it's a big breakthrough for us. But look, needless to say, having Wheeler River right there, Denison is a large shareholder and a strategic partner, provides for a big advantage for us as we continue to advance this project. We'll see how things unfold in the next few months here as we continue to drill out this new discovery.
You say few months. You told me you can basically drill through the winter months. I think you touched upon it, but I must have kind of flew over my head. When are you going back to drill? How long is it going to take you to turn around with some more assays from Fork?
Yeah, so we'll start back up drilling in late September for this upcoming program, and basically probably drill right through towards the end of the year, and we'll have assays coming out as they're received. So likely we'll have assays towards the end of the year, call it October through December, and then likely we'll have another batch that will be out afterwards in the new year. So it's going to provide us with quite a bit of news flow between now and January, February, March of next year, which again, getting back to the seasonality, we see those typically as the strongest months for the sector. And then we'll have the news out from Moore Lake, which, again, the Moore Lake drilling, we know there's high grade there. It's about, trying to prove up as much as we can. So we are expecting, we'll get some additional good numbers from that project. And you never know, we may test a target, a new target that delivers a new a new zone of high-grade uranium mineralization. At Moore Lake back in 2017, we made the East Maverick discovery, and then more recently testing the basement rocks a few years ago, we hit our best basement-hosted zone of mineralization of 7.8%, or sorry, 6.8% over 2 meters. So some pretty good numbers just below the unconformity, and it's open at at depth there at that East Maverick zone. So there's still the strong discovery potential again at Moore Lake, even though we know there are several high-grade existing zones of mineralization.
What exactly do you have to drill at Moore though? And you have, what do you have, 2,000 to 3,000 meters, call it, that you want to drill at Moore. What, and that's not, well, obviously it's not nothing, but it's not a whole lot of drilling. So you have to spread it consciously. Where are you putting those meters?
Yeah, well, it's relatively shallow drilling, right? So you do get a little bit more given that, but we're planning to drill a few more holes at the main Maverick zone as well as the East Maverick zone, and we'll likely drill a hole or two at one of the regional targets that has had a little bit of drilling. There are identified zones of uranium mineralization, but you haven't had the kind of high grade, multi-percent that you see at the Maverick corridor. So most of it though will be at that main Maverick zone and East Maverick zone, trying to build out the resource.
Right. Okay. So chronologically, in terms of news releases that you have coming up, you have, well, potentially some partner news first, then more, then potentially some more partner news, and then Russell. That's kind of how it's going to go down until the end of the year.
Yeah, exactly. So Moore Lake, we'll start drilling there, get the first few thousand meters done. Russell will be the remainder of the year, and then the partner news just comes out intermittently and fairly regularly, as you've seen over the last few years, especially if we add another partner or two in the coming months. Like I said, we've got a lot of inventory. We've got a lot of projects that are available for option. So this is a good way for us to monetize some of these properties. And we also do, from time to time, we've announced additional staking and new project acquisitions. So we're always, keeping an eye out for opportunities to grow the portfolio as well as to, monetize some of it. So between all of that, there's, it's going to be I think our most catalyst rich 6 to 12 months that we've ever had. And most exciting is, the drilling, right? The drilling that we're carrying out now, in particular at Russell. This is, we're very, very pleased with what we've found. It's early, but we're at the stage right now where this next drill hole could be the game changer, especially for, the valuation of the company.
Right. And as you mentioned before, that's all, as far as I understand it, that's all funded. Like, you don't have to go to back to the market to pay for that drilling.
Yeah, we're funded for this program coming up, so we're in good shape financially. And again, we do, from time to time we'll get cash and stock from the partner companies. And again, if we bring in new partners or monetize some of the non-core assets, that's another way for us to, keep the equity dilution in check.
Are you also covering G&A and everything, marketing and everything else that you have going on in the meantime as well?
Yeah, we haven't had to do a hard dollar financing, as I mentioned, in 4 years. A big part of that is, having had some cash come in from various partner companies. And we have had warrants as well. Most of these warrants that were in the money have now come in. So that's covered the G&A, that's covered additional acquisition costs, that's covered some of the exploration. And so, yeah, it's been a good way to, again, keep the equity dilution in check as we, remain focused at the two co-flagship advanced stage exploration projects of Russell and Moore, and have partners advance the secondary and tertiary project.
Yeah, and so why I'm really asking you about this is because, and it kind of leads to the beginning of the conversation where I ask you, what's the market not liking about this? Where you're telling me, well, there's nothing that the market is not liking about this story specifically. The market is just giving absolutely no love to any of the exploration stories right now. And it would just not be a great moment to raise capital in the market right now as a uranium company. That's why I'm asking you about the financings. But this might be a good point to talk about and kind of work toward closing the conversation here. But when do you think that's going to change? I mean, the uranium price does what the uranium price does, but the fundamental thesis for uranium remains robust. Yet the smaller companies are going through massive volatility here and there. When do you think that changes?
Well, yeah, I mean, I think it changes this fall, right? I think I think we're close to a bottom, if not at the bottom here. And again, we have seen this. This isn't something that's unusual given the time of year. I'd say the severity of the sell-off is, it's probably been more than I think most people were expecting. But again, it does create a very attractive entry point, and it does also, I think, showcase the value proposition from a fundamental standpoint. I mean, again, this is when it's important to to go back and really kind of regain any lost conviction on the underlying fundamentals. I mean, there's really nothing fundamentally that specific to uranium that has changed. Yeah, I mean, there was the news last week on Kazatomprom, and they had slightly increased the production guidance this year, right? But the big news will come out at the end of the month with the guidance for 2025. And again, it's a relatively small amount. We're talking a few million pounds that that they increased it by, and the market sold off significantly on it. It's interesting there, given that at their JV Inkai with Cameco, looks like they're going to be producing less this year than certainly they did in the first half. So it looks like their priority's been given to some of the other joint venture operations with the Russians and with the Chinese. So we'll see how that plays out. But there's still systemic issues there with sulfuric acid and development delays. And so again, I don't think that they're going to meet the numbers that they had initially put out to the market. And I think that's going to be a hugely positive catalyst. And that's just a few weeks away. We've got Cameco. I mean, Cameco obviously came out with kind of a mixed bag of results last week, but very, very good numbers out of the basin. Obviously, in Kazakhstan, not so much the case. I think that there was a couple of very important points that were brought up by Cameco, and one of the biggest ones was regarding contracting, right, and contracting volume. So as we know, we've seen a fairly subdued contract market this year thus far, and I think a big part of that that's been discussed thoroughly has been the fact that you've got this Russian import ban and a waiver process. So a lot of the utilities in the U.S. that were probably planning to contract and purchase getting into new contracts this year have delayed that. But as Cameco pointed out, as Tim pointed out on the call, you can delay and defer, but you can't avoid these new contracts. Ultimately, you will have to come back to the market. And historically, when you see a lot of contracting volume, that's typically when you see very, very strong bull markets and years for this commodity. And we almost got to the replacement rate last year of, I'll call it just, it was about 162 million pounds in the contract market. But their, replacement rate of, call it 180 or so million pounds, still haven't hit that point. And, wait till we see that number exceeded, right? And, like 2010, for example, 2005, where you had, over 200 million pounds of volume in the long-term contract market, that hasn't even happened yet, right? So we're still, I think, early on in the cycle here. And again, when we look at the price, a lot of investors kind of focus in on the spot price, which has been very volatile, and that's been a part of the reason for the pullback. Is we've seen a healthy pullback in the spot price from well over $100 to, call it 80 to 85. But the contract price, the long-term contract prices, just continue to march higher on relatively small volume, which I think is a very telling signal as well that it hasn't pulled back, even though the volumes have been relatively light. This new base at, call it $80 a pound, I think is going to be where you see a lot of new contracts that are being negotiated, especially as we enter into the fall season with the WNA coming up. You're going to see a lot of much higher price contracts being signed. And this is, I think, going to spark the next leg up in this market. You've still got a major structural primary mine supply deficit of 40 to 50 million pounds. Secondary supplies are dwindling, and so you don't have the quick supply response in the next 3 to 5 years. Kazakhstan was supposed to be that, but these new larger development projects, they're not coming on in the Athabasca Basin next year or the year after. So there's going to be a market that I think continues to get upward pressure and squeezed higher. And yes, it's volatile. Like, look, you look at the mid 2000s, there were a handful of times in that big bull market from, call it 2002 or 3 to 2007, where, there were 30, 40, 50% pullbacks. And then ultimately, though, if you had bought uranium shares and equities and companies in the early 2000s, we saw the peak in 2007, you did incredibly well. So, it does require some fortitude and patience, but I'm more bullish than I've ever been. The fundamentals are as compelling as they've ever been. And I'm putting my money where my mouth is. I've been buying shares in the open market. I just see there being great value here with Skyharbour at these prices. And again, I think we're going to see a new move higher this fall with a lot of contracting volume, with the market turning around and with the fundamentals continuing to improve.
I hope we can actually sit down for a longer conversation, Jordan, on the uranium market maybe soon, maybe after the WNA, because I know that's coming up. I know you're going to that, so that'd be interesting to get your thoughts on that. But again, the thesis remains the same, right? I mean, it is a supply issue, and it seems like there's no immediate solution to it, and definitely no easy solution, as you mentioned. So it'll definitely be interesting to see where that goes. I am still in uranium myself, so I can definitely use some help here from the fundamental thesis as well. But this has been good. I know you have to go now. I will let you do your thing. What am I forgetting to ask you though? What did you come here hoping to talk about that I'm not bringing up?
I think we covered a lot there, and so I think we've covered most of the salient points. But keep your head up, right? I think that's an important message for investors right now. Like this, it's obviously difficult going through pullbacks. We have seen these before. They've over the last 4 years have been, it proved to be very good buying opportunities. And, specifically for Skyharbour, we're well funded for a lot of upcoming news flow and catalysts. We're, I think, on the precipice of something much larger at Russell. We're continuing to expand the high grade zones at Moore Lake, and we have a number of very active partner companies that, again, if any one of them delivers a successful exploration program, drill program, new discovery, that's a major new catalyst and development for us and our shareholders.
Jordan, it sounds like I should be having you on for an update on the uranium market, and maybe actually next time I will, but I'll let you drop off now. I know you have other things, actually important work to do. They're slightly more enjoyable than look at my face, and I'll go torment someone else here. But to do that, I will actually have to make a trip down to the US in search of, obviously, mountains, ranches, and potentially some uranium, or hopefully some uranium. And Colin Healy will be, well, again, hopefully be helping me find that uranium, as he's the CEO of Premier American Uranium. The company is listed as Pure, so that'd be PUR on the Ventures Exchange in Toronto, where an average of about 30,000 shares trade each day, with a 52-week high of $3.29 and a 52-week low of $1.24. With a market cap of about $73 million and about 46 million shares outstanding. Today, this is a $1.60 stock. There are 4 million options and about 8 million warrants, leaving the number of fully diluted shares at about 58 million. Mike Alkin, who I, by the way, interviewed, it must have been last week or a couple of weeks ago, is part of the founding team here. By the way, this is with his Sachem Cove partners owning 31% of the company. So 1/3 is owned by, well, essentially Mike Alkin and partners. ISO Energy is also another co-founder of this company who now owns 9%, and 5% of the company is held by the URNM ETF, notably not the URNJ ETF, so something that we potentially would touch upon later on. And then there's 2 more significant chunks, each of which 4% large, and they're owned by Encore Energy as well as Mega Uranium. The last financial statement, which is dated March 31st, shows me a $4.5 million in current assets, most of which at the time $4.2 million to be specific, was in cash and cash equivalents, although things will have changed a little bit since, as well as you'll hear in a minute, there's a deal that's been happened, and to my estimation, the company now has about $10 million in cash, or a little bit more than that, potentially, to round it up. No major debt, with long-term liabilities hosting a $175,000 note payable, and short-term liabilities showing a little over $500,000, mostly in the form of account payables. That same financial statement from the end of March also tells me that, on average, over the last reported 3 months, Premier recorded about $190,000 a month in administrative expenses, mostly in the form of salaries, as well as professional and consulting fees. This is, by the way, excluding share-based compensation, which, by the way, was $575,000 worth of shares for that whole 3-month period. As to exploration and evaluation, there was not much happening. So there was a total spent of about $150,000 for the 3-month period, in total, equating to, well, about $50,000 a month on average, with the majority of money going into upkeeping the annual mining claims in Wyoming and Colorado, as well as some personnel costs and a very, very small staking cost as well. And as I said, there was just not much happening in terms of exploration, but this is typically where I'd provide the exploration to administration ratio as one of my favorite ratios. But it is, again, worth noting that Premier is first of all, it's a relatively new company that completed its listing, that was done through an RTO, by the way, only late last year. So do keep that in mind when looking at that exploration to administration ratio. But more specifically, there was a give or take $250,000 average monthly spend over the last reported 3 months, with administration making up 80% of that. But as always, I would like to remind listeners and viewers that this financial statement is nothing more than a snapshot in time. In this case, it was specifically at the end of March of this year, and it discusses the first 3 months of this fiscal year. The finances will most definitely have changed by the time you're watching this, partly because this is a non-revenue generating company, again, a new company at that, and partly because since this report was published, the company has closed the transaction that we'll discuss later on, as well as they've started drilling since then. So that administration to exploration ratio will be different. So best thing you can do is head over to the company's website, as well as setterplus.ca, to look at all the numbers yourself and make sure you're getting the full picture. Incredibly exciting accounting fun aside, we're here to talk about uranium, and Premier American Uranium is again, a new company. It's actually a spinco. They were spun out of Consolidated Uranium, and Pure now appears to have really a threefold plan for tackling the uranium market, with one component being obviously uranium exploration, and another one being uranium consolidation, or better said, M&E, and a third component being development of their in-ground resources into producing mines, or, again, potential takeover targets. First things first, though, uranium exploration and development, they're doing that in the U.S., as I mentioned, and more specifically, New Mexico, Wyoming, and Colorado. And in New Mexico, New Mexico is, by the way, the 4th largest uranium district in the world. Premier has the Ceboleta project, which they control 100% of. This is an advanced stage exploration story with a recent resource estimate on it from April of this year, showing 18.6 million pounds in the indicated category, and almost 5 million pounds in the inferred category, with average grades being 0.14% and 0.10% respectively for each category, with about 30% of the indicated stuff being open pitable, and thus 70% underground, while about 47% of the inferred uranium being open pitable, with an assumed 95% recovery for both the open pit stuff as well as the underground. Quite the difference, actually, between the open pit and the underground, mainly because this resource is not one thing. Like, it's not one continuous thing. It's actually made up of 8 different deposits, or 8 different areas. They are, of course, as one would expect for that part of the world, sandstone-hosted deposits, pretty much identical to the other large deposits and historically producing mines in the area. But Pure, of course, doesn't think that that's all their land package has to offer. They believe there is room for growth and more pounds, which they'll be looking for in an upcoming drill program, with multiple targets having just been outlined for exploration drilling, which, again, I hope we can discuss later on. Over in Wyoming, though, which must be one of my favorite places in the U.S., but only because I watched too many episodes of Yellowstone, Pure has its eye on a potential ISR project, which is not too far off from another fan's favorite, that being URG's Lost Creek operational mine, which is also obviously an ISR mine. Cyclone is what Pure calls the Wyoming project, and Cyclone was drilled about 15 years ago or so ago, with about 80 holes going into it and showing styles of mineralization, again, similar to Lost Creek and other current and historic deposits in the area. More specifically meaning flat-lying sandstone. So what's left for them to do now is truth test it with a truth machine with a very specific 71 holes or 49,700 feet of drilling planned for the currently ongoing exploration season, budgeted at around, well, they call it 2.3, but you can say $2 to $2.5 million budget for this drill program. And for people using normal metric systems, as everyone should, by the way, that's about 15,000 meters of drilling that we're talking about here. Or that would actually be an average of 200 to 250 meters depth per hole for those 71 holes. But those are going to be split across two different targets that the exploration program, it's already underway as we speak, as I mentioned. So hopefully, again, we can talk about later on. But so the depth will be different between the targets. Again, maybe I'll not go into too much details on it now, but we'll talk about it later. And in Colorado, it doesn't appear to be a main focus for Pure, although they do have multiple projects there. 4, to be specific. They're all located on the same Uravan mineral belt that has produced almost 80 million pounds of uranium historically, and a decent chunk of vanadium too, since the mid 40s, really, so a long time ago. Typically on this belt, we'd see tabular sandstone reduced oxidation hosted uranium, well, vanadium and uranium deposits, and so that is supposedly the thesis that Pure is working with as well. All 4 land packages, which again, there are 4 different projects. They're not continuous to each other, but they're not too far from each other. They're all on the same belt. All 4 of them are 100% controlled by Pure, and they all host past producing uranium, vanadium mines. But again, they're not the main focus here, so I won't spend too much time on them. Though again, hoping to touch upon them later on in the conversation. As I mentioned, though, one more brief note, and I'll work towards shutting up, I promise, but Premier has an acquisition element to its corporate strategy, as well as proven by the recently closed acquisition of American Future Fuel, where Pure essentially bought 100% of American Future Fuel for 15.5 million shares, I believe. So again, 6 exploration projects as I could count them, which is about as far as I can count. 1 exploration program in Wyoming is ongoing as we speak. Another planned and outlined really in New Mexico. There's 4 more projects with past producing assets on them in Colorado. And there's also an acquisition strategy, all of which sounds very interesting, Colin, but it also sounds like a lot of work and a lot of complicated work as well. And given it's your first time on the CEO barbecue here, obligatory first question: why should I trust you with my money? Why are you the right guy to make this strategy work?
Well, thanks a lot, Antonio, for the great introduction, first of all. I think that what I've done for the last 16 years is study uranium projects in the US, Canada, globally, working on valuations, watching how they evolve, figuring out what the best way to advance them is, what unlocks the most value for shareholders. As an analyst in the space, the primary focus was the shareholder, the potential value that could be unlocked, evaluating management, evaluating corporate strategy. So I really became familiar with and formed an opinion about best practices and how I thought a project should be developed and approached, and how I thought management should focus its energy on the marketing of the company, the advancement of the assets. I think another layer of trust that you get here is when you invest in Premier American Uranium, you're investing along Sachem Cove, one of the most successful, knowledgeable uranium investment funds in the world. Between co-founders Mike Alkin and Tim Rotolo, you get guys who have, they're second to none in terms of their due diligence and their knowledge in the space. From your own experience interviewing Mike Alkin, his knowledge. So and on top of that, Tim Rotolo is our chairman. We've kept, as you mentioned, we were spun out of Consolidated Uranium, and at that time we were first listed in December of 2023. And at that time, the assets that were contributed were those Colorado assets that you mentioned, coming from Consolidated. and a company called Premier Uranium that Sachem Cove created to go out and stake uranium assets in 2018 when the space was very quiet and there weren't a lot of people that early on the thesis recognizing that the imminent production shortfall was going to create a unbelievably robust supply-demand scenario for the commodity. And so Premier Uranium was contributed by Sachem Cove to create Premier American Uranium. And within our DNA is this consolidation strategy carried out by Mega Uranium early on in 05, 06, and then later on from 2020 to 2023 by Consolidated Uranium, extremely effectively with great returns for shareholders. And we've got Marty Tunney, who's Chief Operating Officer of ISO Energy, on our board as well. He was the former chairman when I joined as CEO. He stepped aside. Tim Rotolo was CEO. He became chairman. So just a really, really strong pedigree with the team. And obviously, I was the guy that they chose to take over the CEO role. So you get their vetting of me, you get their advisory experience and oversight of myself and the management of the assets. So I really think Premier American Uranium is second to none in our size and space in the uranium sector for kind of management, strength, and oversight and experience.
There's something I always say, but it's easier to trust a person when they trust themselves. So I suppose a follow-up question here could be, are you trusting yourself with your own money? Like what percentage of your net worth would you guess you've put into this company, as in hard dollars, not shares that you got for getting on board or something like that?
So it's a great question, and I have an explanation because I haven't taken a position. I do have RSUs and options that are disclosed, granted by Premier when I joined. But when I joined on March 20th, we also announced the acquisition of American Future Fuel under that first pillar of the company, the acquire, explore, develop.
I'm sorry for interrupting here. That was March 2024, right?
Yeah, correct.
I think you said March 2020. That's why I was kind of confused.
Excuse me. You're right. Yeah.
Okay. I'm sorry about that. Go on. It's not. I'm sorry. Go on.
Nope. It's good. It's good to be accurate. It was March 20th of this year. So I've been on board since that time. This company's only been trading since December of 2023. But the answer is we were in the process of an acquisition. So we were kind of blacked out and not in a position to purchase shares in the open market during that time. So I haven't made any personal purchases of Premier, but I intend to, make the most value of the options and RSUs that I've been granted and invest over time, and put my own money into the company at various opportunities as they come up.
No, okay. So what you're saying basically here is like open market purchases or participating in financings is still going to be on the table for you moving forward.
Oh, definitely. Yeah. And I fully intend to increase my exposure. My entire livelihood is invested in the company from a, sustainable life perspective here. But I haven't purchased any stock, and a lot of that had to do with the conditions that under which I entered, being at the beginning of a M&A transaction. Okay,
good. As I mentioned at the beginning, I calculated about $190,000 a month on average in terms of G&A as to what you had spent the previous period. Not necessarily representative. It's not a good thing to annualize these numbers when it's only a quarter that we're really looking at. But what do you think your total G&A is going to be like? What are you budgeting for G&A per month on average?
I mean, you're not far off with that number, but the number in the first 3 months of the, let's call it 4 months, as I said, we just started trading December 1st. The March financial statements are kind of the first kind of filed statements as a full quarter of operations, and they're not representative. And when you're doing M&A, as we did throughout the following quarter, there's costs in there that are non-recurring, legal, advisory, and so on. So it's like the administrative burn is lower, but we've just started a drill program in Wyoming in July that we intend to. You mentioned it was a $2.3 million budget approximately. Now that program, people should understand, that involves two targets, which you did mention, the Cyclone Rim target, which is slightly to the west on the map, and then the Osborne Draw target to the east. And that program is being split between 2024 and 2025. So it's about 1.3 million US budgeted for 2024. Our drilling window in Wyoming for this project is July to October. There's sage-grouse restrictions leading up to July that keep the drills from turning until about July 1st. And then usually around mid to late October for weather reasons we wind up drilling. So our expectation is to spend 1.3 million US drilling that rim target, about 35 of the 71 holes that you mentioned this year, and then in 2025 drill the other 36 holes in that same window, July to October. But then there's most of our spend for our 2024 spend is covered by our current cash, and we're budgeting about another US $2 million spend in New Mexico. But I imagine we're gonna talk specifically about the plan in New Mexico, so I can lead that for a few minutes. But yeah, as far as the administrative budget goes, including marketing, it's $100 to $200,000 a month, but it's going to be very, very kind of volatile for that line item, depending on how active we are in the M&A front, and we expect to be quite active.
I want to talk about all these things, Colin, and definitely the drill program later on. But you actually bring up a good point. This may be a good point for me to stop being annoying with these questions and talk about what you do have planned on. But what would you say is, because as you said, it's a 3-pillar program, corporate strategy that you're really going for here. What would you say the split of the focus is? Like, what percentage of your time goes toward working on M&A stuff versus exploration versus trying to put stuff into production?
Well, the way that it's gone so far, in terms of my time, it's easier to split that up in terms of time than it is in terms of money, because we don't know necessarily what we're going to be acquiring. And for sure, cost of acquisition are going to exceed cost put into the ground. The American Future Fuel is a great example. That was a transaction that was valued almost at half the value of the current company. So we're not spending anything like that on exploration. But in terms of my time, acquisition and consolidation is an extremely important part of this company. It's in our DNA. It's what we were kind of conceived upon, is to go out and acquire things selectively and accretively that complement our existing portfolio. So from my time perspective, obviously from March until the end of June, when we closed the American Future Fuel transaction, that was dominant, 75-80% of my time. But within that time, we also had to prepare for this exploration program in Wyoming that we just kicked off. So 25 to 30% of my time, and we're talking about 14-hour days. So a lot of time went into what it takes to mobilize a drill program. I inherited a very strong technical and regulatory team. They had already been working on the permitting requirements for the Wyoming drill program, but none of the contractors had been locked down. So that you've got drillers, mud suppliers, probe operators, a lot of different pieces that have to be contracted and reviewed, hired, budgeted for, and so a good 30% of my time was spent working with the technical and regulatory team, figuring out how we were going to execute that drill program. And obviously, we succeeded in getting that done. We started drilling in Wyoming July 12th. But I think that is probably about the right ratio going forward. Now that we've got the American Future Fuel acquisition behind us, we're evaluating a pipeline of, given the experience of our technical and regulatory team, there are few projects that these guys aren't intimately knowledgeable about. For example, Ted Wilton, one of our geologic consultants, prior to us updating that technical report at Sebieta in New Mexico, which we had to do as part of that acquisition transaction, that resource that you just mentioned that we brought current, the prior tech report was written by Ted. So we're acquiring a company where our technical advisor was extremely familiar with the asset that we were targeting when we announced that acquisition. So I expect to spend, upwards of 70% of my time evaluating acquisition opportunities and working on this consolidation strategy.
What would you say are criteria that you typically look at? And this is particularly important to me, specifically because of your background as an analyst, and specifically uranium focused analyst. What's interesting to you, and how is that different than what might be interesting to me as a retail shareholder? Like, yeah, just talking about the criteria that Premier American is going to be using.
So for sure, everything's important, but from a high level, we're looking for assets that are going to complement our existing portfolio. When you think of, and I know how I'm intimately familiar with how uranium stocks have been performing the last couple of weeks, but I don't see anything on the fundamental landscape that's materially changed. So I'm extremely bullish about uranium price 12 to 18 months going forward. And I say that because my comment is, in an environment where you have $80 plus uranium, it's going to be competitive for quality assets. And I think Premier's advantage in this position with our shareholders and our knowledge base and the assets that we've already got is our ability to evaluate assets, pay a fair price, and find things that complement our existing portfolio so that we don't overpay. In a competitive environment for assets, for quality assets, if you're not complementing your existing portfolio or building a thesis on a new kind of regional concept, then you run the risk of overpaying. And when we're complementing an existing portfolio, we can afford to pay and win in competitive scenarios because of the potential to complement the existing portfolio. So first and foremost, when we're thinking about acquisitions, we're thinking about things that complement the existing portfolio, are additive, that could be somehow combined in a future mining concept or kind of revenue stream concept, if not. So, we look at other assets in the Great Divide Basin or proximal in Wyoming, for example, or other hard rock assets in New Mexico that make sense. Things that complement our existing portfolio. Jurisdiction and regional politics matter. One of the attractive things about the Sebieta project that was inside American Future Fuel was the fact that it's on private lands. Those lands are controlled by Navajo. They don't have external issues. Potentially, we're going to work on demonstrating economics, of that project in 2025, and we believe that we can prove or give a mining concept that is self-contained within that project area on private lands, and we think that's a huge advantage. There's definitely difficulties as we're seeing play out in kind of in other news with even transportation of material across Navajo land, for example, can be a challenge, and it needs to be managed. So we like assets. Wyoming is a fantastic jurisdiction to mine in and develop assets in. We saw Nichols Ranch get built. We saw Lost Creek get built in the last kind of decade, 10 to 12 years. and both operated successfully following construction. So I love Wyoming ISR. I love it as a jurisdiction, as an agreement state for potential development. So we'd definitely be looking at assets that complement the Wyoming portfolio. Cyclone is that the project that we're drilling now is only about, you alluded to it, but it's about 10 to 12 miles to the west of Your Energy's Lost Creek.
Yep.
The prior technical report on that project outlined a 7 to 12.5 million, or 8 to 12.5 million pound resource exploration target. That's what we're out there drilling. You said truth it up. That's exactly what we're out there to do, but we're being strategic about it. So we're going to drill holes that are going to give us information about how to vector in on. We have some information, obviously, with this resource exploration target about where we can go and hit mineralization, and we're going to drill some holes there as well. But we're also going to drill holes that help us vector in on mineralization extents and be efficient about potentially proving up that resource. And I believe that if we can, show a 10 to 12 million pound, or delineate a 10 to 12 million pound resource over a few drill programs, that this would be an extremely attractive satellite to Lost Creek, for example. The target grade at that asset is 0.06% within that exploration target. Lost Creek has been operating extremely effectively, processing. They produced about 3 million pounds to the end of 2023 at a grade of 0.049%, I think was the average head grade at the plant. So we're looking for something that's 10 to 12 million pounds that at grades equivalent or better. And if we do that, I believe at uranium prices in excess of $85 that this could sustain or justify its own processing plant, but it'd also be an extremely attractive satellite plant to a plant like Lost Creek. And so there's multiple ways to kind of demonstrate value. Proving up that resource is primary. Showing its attractiveness to other operators in the region for sure. Creating our own hub and spoke strategy through acquisition is the real kind of end game. So going out and trying to prove critical mass at Cyclone, but also looking for assets that could potentially be satellite plants. Kind of carrying out the concept of demonstrating a hub and spoke strategy, like companies like Your Energy, UEC did back in 2008, 9, 10, 11, in their earlier days, is what I envision happening in Wyoming for us. So we're going to be out there acquiring things that complement the existing asset while trying at the same time to delineate a resource at the existing asset. So long-term vision, a hub and spoke strategy in Wyoming, built through acquisition and exploration, really in line with the fundamental strategy of the company.
That's a very interesting point, and I hope we can go back to it once we're talking more about this drill program in Wyoming. But it sounds like you're going to stay focused on the U.S., and I suppose it makes sense because you didn't call yourself Premier Americas, but you call yourself American. So are you just going to stay focused on the U.S., or how is that going to work?
Yeah, for sure. The strategy is, my personal thought. That is a strategy. We're going to be U.S. focused, and you probably see us focus on the jurisdictions that we're in, because of what I said before about the competitiveness of accretive assets. We want to find things that complement the existing asset base to justify the cost and extract the most value from them. But the U.S. focus is underpinned by the U.S.'s dramatic difference between uranium consumption and supply. We've seen incredible bipartisan support for uranium in the U.S. So there's a lot of catalysts happening in the U.S. right now politically that really demonstrate the U.S.'s intent to take back leadership and energy independence in the nuclear space. And I think that that's eventually going to encapsulate uranium. There's been a heavy focus on kind of the first pieces of that, avoiding Russian enrichment through the low enriched uranium ban from Russia. But, you know, we're starting to see large investment commitments in internalizing enrichment capability. And, you know, we saw the RFP for, I think, up to 3.4 billion to acquire low enriched uranium to help offset the potential the potential difficulty in acquiring or replacing Russian contracted low enriched uranium near term. But I think that, you know, that's going to trickle down to the uranium space. One of the things that that I expect to be a catalyst for U.S. uranium is that, you know, like our Sebieta asset, for example, 23.5 million pounds of current resource, historic production, metallurgy, at least in some form of conventional production. I'm fairly confident it's going to hold up because of the past production from the site. You know, I think that because of the difficulty of opening up new mines, and because of, you know, even with the visibility of new mines that we have, by 2030 we're still going to have a substantial shortfall in supply, and brownfields and existing resources in the US are going to be an excellent potential opportunity to fill those supply gaps. I think we're going to need substantially higher uranium prices to incentivize production, but I think that you're going to see support from government and from political support for the process of bringing new mines into production. I think that the United States is taking energy security seriously, and I think it's creating catalysts for potential uranium production. And I think uranium price is going to be there to support it. Because I think fundamentally we just don't have visibility on the mines that are going to supply the reactor fleet that we expect to be in place by 2030. But, you know, also because I expect the United States to prioritize domestic production in some way. And there's a few different ways that they can do that. I mean, there's definitely political support for the permitting process or simplification of permitting processes. And, you know, it has to be coordinated. The state and the federal level both have a lot of say on how those things move forward. But I think that a lot can be done politically without financial support, because I think the uranium price is going to be there. I think a lot can be done politically to help move uranium projects into production in the US. And so because of the US's proven ability to produce historically, and the number of brownfield assets in the US that could potentially be brought into production, I think that they're going to be very relevant in filling those supply gaps down the road.
It feels like we should have a podcast just about uranium in the US and how that's going to work in and of itself. That would be a good idea, actually. But I do appreciate you having fundamental reasoning behind your corporate strategy, and it not just being, you know, promote or whatever else it might be, which it often is, unfortunately. So I do appreciate you having fundamental reasoning behind what you're doing right now. To go back to criteria and how you structure those deals, and when it comes down to M&A, though, is there a strategy behind financing those deals? Like, is it a broad strategy, or is it sort of a see as you go type of thing? Like, are you only doing all share deals like the last one you did, or is there going to be a cash component to it in the future? How do you look at that?
I think that right now it will depend a lot on size. If we see some smaller cash incentivized tuck-ins of land pieces that aren't too expensive, then cash is on the table. But, you know, for larger transactions, given the size of our company, it makes the most sense to use our stock as the currency. And I think that was quite effective in the acquisition of American Future Fuel. I don't think that that large cash transactions make sense at our size. So it's going to be mainly using the stock as the currency, I think, for anything quite material.
Sure. Let's talk about the other side of the business then, with that being exploration, and you're again currently drilling in Wyoming as you brushed upon earlier. What do you say? This is it's a generic question, but it's going to open the conversation to more in-depth stuff. What do you think is the main unanswered question that you think those 71 holes will answer for you?
So what we're trying to do is go out and gather more data than we have that underlies that resource exploration target that was produced in that independent technical report. But several of these holes are designed to really get an understanding of what that roll front geometry looks like, where it's located, finding the nose of it, finding the dimensions of it, and then starting to vector in on the kind of ore grade mineralization that we know is there from past drill results. That you can see the highlight drill results in our presentation. Some of the holes of that program I expect are going to produce forward-looking statement, but we're going to be drilling in areas that we expect to be mineralized, so we should be able to replicate some of those historic results. But the main idea of it, not having the entire historic database underpinning, they're developed in those 88 holes because it's that data is controlled by another group. It's really to go out and gather that data on our own and start to understand what the most efficient way to delineate a resource there is. So it's not completely blind exploration, because we can go out into the field and identify historic drill collars. We know where they are, but we don't have all the data for every single hole. And for that reason, this drill program is largely designed around building out that database to be effective in our next drill program and delineating the resource efficiently.
In your recent news release about it, you also mentioned the potential for 8 to 12 million pounds of I'm rounding up, but 8 to 12 million pounds of uranium on this project, which is a rather specific target. And I assume it will take more than just RC drilling to get there, that's what you're doing. But how many drill programs do you think it'll take before you can come out with a resource that fits within that range? And more specifically, how much money do you think you'll have to spend on, or how much money do you think is going to have to go into this project before getting to that final goal of 8 to 12 million pounds?
Well, I think that probably it really, that's a difficult question, because it depends on how much data we can gather in the first 35 holes at Cyclone Rim and 36 holes at Osborne Draw, the two different targets within this project. But if we get the data that allows us to design a very effective delineation second phase drill program, then potentially you could be looking at resource delineation after two programs. Like, again, the first program or first phase of drilling is split between 2024 and 2025. But in 2026, if you've got the data that you need to go in and start to drill kind of on fences with the intent of delineating resource, you could potentially do that in two programs. If we consider the first phase 2024 and 2025 one program, then a similar multi-rig program in 2026, and you could be delivering a resource by 2026. But it really does depend on how effective, or if we have enough data from 2024 and 2025 drilling to start to design drill program for 2026 that vectors in and with adequate spacing, vectors in on the mineralization and kind of delineates it or delineates it to a effective degree, where we're comfortable with that we've captured enough of it, that we'd like to show it to the market. If there's still more work to be done to kind of show the critical mass there, and we're confident that additional drilling would do that, then we'd make that decision and delay a resource, but be very communicative to the market about what we've seen, so that we can, so that analysts can start to, build their own models And, this is the process. You go out and you drill and you try to get an idea of the geometry of the geological structure that you're trying to drill, and then drill more effectively in the next program to really kind of hit mineralization, track it, see the extents of it. And if we do that in our kind of second phase of drilling, then we'll be ready to produce a resource. If we're seeing that if we have the belief or we're mapping mineralization to a significant degree outside of where we've already drilled, then maybe we hold off, or maybe we do a resource and then with the intent of following up with a second resource. So it's going to be dynamic, but I think that the earliest that we could think about a resource would be late 2026, given that our first phase of drilling is not going to be complete until October of 2025. So that's for Wyoming.
I understand it's going to have to be dynamic the way you do this, also because the 2 targets that you're drilling, right? And then potentially there could be more depending on what you find there, of course. And that's actually maybe an interesting point. And I would like to, I'm already getting more ideas about potential future podcasts, but we should maybe do a geology deep dive, because I think Wyoming uranium geology is interesting as well. But so those 2 targets that you're drilling there, they're comparable geology as far as I understand it, but yet you have to drill one of them 500 and for Cyclone Rim, and then 800 feet for Osborne Draw. Why is one of them, like, why is Osborne Draw almost twice as deep?
I mean, to answer why, I mean, you're talking about just the formation and the depth of the formation from surface,
but it's got nothing to do. Let me tell you why I'm asking this. I'm interrupting again. I understand, but just to clarify, what I'm asking is, it's got nothing to do with topography or accessibility. Like it's not like one of those targets is just better placed, as in closer to road or closer to infrastructure or something else like that.
No, yeah, it's just the formation and the direction that it moves underground. And I think it would be worthwhile to bring the technical team in there. They may have some interpretations about how that formed or why it's depressed. But in general, it's not a topography question. It's more of a formation occurrence question, and it's you get what the rocks give you. And the historic drilling encountered uranium at Osborne Draw at about in around 700 feet foot depth, and shallower at Cyclone Rim, and that's just the way it is. Both of those depths from an ISR amenability perspective are fairly straightforward, reasonable depths below the water table. So in terms of ISR amenability, they shouldn't have substantially different characteristics. It's merely depth. Deeper is probably slightly more expensive wells in a development scenario for sure. Everybody would prefer shallower, but also still below the water table and ISR amenable. Those criteria that you need to be ISR amenable. But it's not a substantial difference, even though, like you said, it's twice as deep. It's not. It's not at depths where it becomes problematic for future ISR development. So if there's substantial or critical mass of resource there, it's going to be quite exciting, whether it's 700 feet or 400.
I would also like to understand the historic drilling on the project and what work has been done. But again, that might be better explained by your tech team. So maybe we'll get them on at a future point. Permitting wise, I believe this is on BLM land, so that could sometimes be a point of issues in the US. So talk to me about that. How many pads do you have permitted now? How many holes will they give you beyond the 71? And how long is the permit for?
Well, the permit covers all 71, and the permit
but not beyond?
No, that would require additional permitting work.
Okay.
So we as we move through and start to interpret the drill results, you really want to know where exactly you want to drill before you start to apply for permits. So to apply for, when we start the permitting process beyond the 71 holes, we're going to have all the data from the 71 holes. Now we can start that process for the western target, the Cyclone Rim target, because we're going to complete that drilling in 2024. And, you know, I should say, if we complete all 31 holes in 2024, but early enough that we'll be able to move over to that eastern target, Osborne Draw, and start to drill some of those, 35 holes at Cyclone Rim. But if we can complete all 35 holes, we may be able to get a couple holes into the Osborne Draw target this year. But most of that I expect to be carried out in 2025. But to answer your question, when you go to permit, you need to know the locations of your, and you have to have your drill plan. And so we need the data from this program to start to prepare for the next phase of drilling. So the permitting process was carried out quite effectively for the existing program. I don't expect it to be substantially more difficult. We have an excellent regulatory affairs team that was quite effective. Obviously, we're drilling. And in this area of the Great Divide Basin, there's a lot of drilling activity, and the regulatory bodies are used to processing permits and evaluating permits. So I don't see a problem, but in terms of when we have the permits for phase 2 drilling, that's going to depend on when we're in a position to apply for them, which is going to be contingent on evaluation of the data that we get in the first program.
How was that process for you the first time around, and do you expect it to be challenging the second time around? I'm kind of continuing on to this topic that is not widely discussed, because I've had experiences, and it was more in southern US, but I've had experiences where it was really hard to obtain follow-up permits. So how do you see the permitting regime treating you moving forward?
Well, I think we've had a really strong relationship. I think the most important thing in maintaining the relationship and making it possible having a good pathway to additional permits involves being competent, following the conditions of your existing permit, carrying out your reclamation as perfectly as possible. All these things are kind of outlined within the permit. How you're going to operate when you're there. How you're going to carry out reclamation, your reclamation inspections. All these things, if you stay in dialogue with the regulators continuously and maintain that relationship and show that you can comply with the permits and just be effective at drilling and reclamation, then it eases the process. You gain confidence with the regulatory bodies, and it helps with continuity of those drill permits, successive drill permits. So I think the most important thing is to just stay in continuous dialogue with the regulators, and demonstrate that we're competent and capable of complying with the first phase of permits, and that will go a long way in application for the next phase.
What about everything else? I mean, locals, fishes, birds, everyone, and everything else happy with your operations as well?
Yeah, I mean, we're operating with it's an integrated approach with all of the groups that are impacted, including different flora and fauna restrictions. As I mentioned earlier, we generally can't drill in this area of the Great Divide Basin until July 1st because of the sage grouse rule. And there's other animals and plants that need to be observed and worked around. And it's really part of an integrated process with the regulators to make sure that we're always in compliance and doing exactly what their preference is, so that we can continue to operate effectively.
When the ISR potential here is of course the main value driver, one of the most interesting points for me, because I think it opens a lot of doors, not only operationally but potentially M&A wise as well. Did you have to get any specific permits in order to do any test work on test the potential, albeit preliminary or something like that, or can you go ahead and run ISR tests as it is?
No, we wouldn't be in a position to install test wells and perform pump tests. That would be a separate. In general, I think that when you want to get into porosity and some testing can be done on core in the future on a lab scale, which you're entitled to do. But in terms of pump testing and underground testing and in the installation of test wells, that's a different series of permitting, and that would be those are things that we would look at doing after we delineate a resource.
Oh, okay. Well, but with that, I guess that's supposed to get a little bit more specific on what you previously told me. What would success look like from this drill program, but then also moving forward? Like, what's the bare minimum that you would consider? Oh, this $2.3 million that you're spending this and next year combined, we consider that money well spent. What will that bare minimum be for you?
I think the bare minimum for me is proving up the existence of the mineralization in the areas where we see the historic drill collar. So, going in twinning holes, proving the mineralization continues over significant distance between holes and to new locations that weren't part of that historic drilling. That would be success. Once we start to know something more about the extents of mineralization, and we can develop a plan around those to do some real delineation drilling on fences and start to gather the data required to backfill a resource estimate. That's really the goal of this program is to get enough data to design a next program that would result in the acquisition of data required to produce a resource. So if we can do that in 2 phases of drilling, I'll be really happy.
I kind of low-key expected you to say something along the lines of, if we can get URG's attention, that would be a success. Is that part of the strategy? Is that part of the reason why you're drilling this, as in potentially building a takeover target that would fit URG's portfolio? Or are you building this with the idea of, we really just want to, bring this into production ourselves?
I think it's extremely hard to predict when you have someone else's attention who's not vocal. I think, attention will show up in the market. If we got approached, then we would know we had someone's attention. But, recognition for results, I think, will show up in the market first. But I think that, from an analyst perspective, you always want to be advancing a project. Like I mentioned earlier, I think that there's going to be there's already plans in the United States from multiple near-term producers to ramp up production, right? We're seeing that from multiple directions: UEC, Your Energy Fuels, Encore, Peninsula, and I think that as they realize success and as uranium prices go higher, that you're going to see them out more aggressively looking to backfill their production pipelines. So I do think that that's going to be in play 24 months from now, or even 36 months from now. But from an analyst perspective, you can never rely on a takeout. So the best thing that you can do to demonstrate the value of your project for any audience, including potential acquirers, is to advance it. Work on your permitting in parallel with your resource delineation. Work on just every aspect of the project to de-risk it and move it towards production with the full intent of bringing it into production if an acquirer doesn't come along. And I think that's the most attractive or the thing that you can do best to attract a potential acquirer, is to advance the asset. Because in 3 years, when existing producers who are kind of neo producers right now, when they're looking to backfill their production profile, they're not going to be looking for an asset that hasn't been advancing environmental baseline studies and things required to get into production. They're going to be looking for things that are almost production ready. So you have to be that. You have to be advanced on every pathway possible in parallel to make your project a priority among multiple resources, if that makes sense.
It definitely makes sense.
Yeah, so I would just say that, you know, my intent would be to always be advancing it towards production, and in that way making it the most attractive potential acquisition candidate.
It's a different sort of switch that you have to make in your brain. It's like you're actually moving in one direction that would eventually put you in the different, or put you in a better spot to switch direction and go to a different spot, because building a takeover target is essentially building something that is production ready, something that you could bring into production. So what you're saying here, Colin, makes sense to me. And that's also not the only thing you're doing as time is kind of moving up on us. I want to talk about the other stuff that you're doing, you're spending. So this year, as you said, the part of the drill program that is going to be in 2024 is about a million something dollars. Spending about 2 million on G&A, 2.5, call it, if you will, this year. That leaves you with $7 million cash. What else are you going to do? I mean, your most recent news release was it actually outlined new targets for expansion at Ceboleta, which, by the way, means spring onion in Spanish. So cool name there. Well, interesting at least. But it's yeah. What's the plan for the rest of the $7 million? Is that including New Mexico? Or are you going to Colorado? What else are you doing?
Yeah, I think Colorado is definitely something that we're not planning to spend money on in significant money on in 2024, and possibly not in 2025. We're doing some background work to acquire some historic data on the Colorado assets, so that we can build a plan around them. But Ceboleta is actually extremely important, and we haven't talked much about it, but this is the asset that we were targeting when we acquired American Future Fuel. And, you know, we've had some unbelievable success. It had an 18.9 million pound historic resource on the asset when we began the process of acquiring it. Through the process, American Future Fuel had done a phase 1 drill program to start to prove out that historic database that underpinned that historic resource. That phase 1 drilling meant that the exchange required us to do an updated 43-101 report prior to, as a condition of closing the acquisition. So we had about 45 days to pull that together, but we had the historic database and we had the phase 1 drilling, which reconciled, that American Future Fuel had carried out, that reconciled extremely well with the historic database. And the QP that prepared the updated 43-101 was able to accept the vast majority of the historic database on that Ceboleta project, to bring that more than the 18.9 million pound historic resource current, but, you know, adding another 25% to it. So measured and indicated plus indicated plus inferred 23.5 million pound current resource, just on the back of that phase 1 drilling, because it validated that historic database so accurately. This was a huge win for us, because the plan at Ceboleta was to spend another $1.5 million US in 2024 to go out and do phase 2 drilling to further prove out that historic database. But with that historic database accepted and now integrated into a current 43-101, this opened up the door for us to go out and spend money on what I consider to be much more impactful drilling, resource extension and expansion, exploration style drilling. The caveat is that in March of 2024, American Future Fuel was on this pathway of preparing for phase 2 drilling to prove up the historic database. They applied for a part 3 permit, which is a low disturbance permit that would have allowed them to go out and do what was in the scope of that phase 2 drilling. Now that we have a current resource that includes all that historic drilling, that phase 2 drill program that was budgeted for almost $2 million US was no longer distinctly necessary. It's a huge advantage for us, because we delivered the current resource at least, you know, 12 months earlier than we thought that we would be able to. But on the other hand, we have a part 3 permit application in progress that doesn't necessarily, or would require significant amendment to allow us to go out and drill this thing aggressively in 2024. So what we've done is initiate work to apply for a part 4 permit, which allows for a much larger disturbance area, but it allows us to go out and do the higher impact exploration drilling that would allow us to kind of grow resources there. So we've outlined all these several exploration targets that you mentioned from our last press release. But to go and drill those requires a different kind of permit than the one that was appropriate and applied for back in March. So in 2024, something less than $2 million is budgeted. We're working with our Part 3 permit, right? Our second Part 3 permit that was applied for back in March right now to see what we can do under that permit. There is some drill work that needs to be done under that permit, so the permit isn't wasted by any means, but it's also potentially amendable to include some different drill hole locations than were in the original application that might allow us to show some resource expansion potential. But we won't know until we get that permit and then evaluate what we can do under it in 2024. So the short answer is we need a Part 4 permit to go out and aggressively drill Sebieta and show resource expansion potential. That's going to be an all-in about 12-month process. So I expect to spend $4 to $5 million US in 2025 on Sebieta, working on exploration and resource expansion. But in 2024, we will still probably do some light drilling. We need some core drilling done to get some technical data that's going to support potential PEA in 2025. So we've got big plans for Sebieta. It's a 23.5 million pound current resource that we got much sooner than we thought. So we're adapting to that and changing and applying for more advanced permits so that we can do what we expected to be doing probably 12 months from now. So 2024, we'll look to aggressively do exploration drilling there, and then towards the end of 2025, under Part 4 permit that we'll be working on applying for, we'll do some aggressive exploration drilling, and hopefully towards the end of the year, potentially a resource update and potentially show preliminary economics in a PEA at Sebieta in 2025. So really emerging as the flagship project for us quickly here. But it's not going to be a boring story in 2024. We're going to be able to do some drilling under that Part 3 permit that we've got, and potentially we're looking at the possibility of amending it to do some holes that would show the exploration potential that we'd be really focusing on in 2025.
2020 just kind of rolls off the tongue, so I wouldn't blame you for that. It's way easy to say it. I say it all the time. But what I'm getting here from you, Colin, tell me if that's correct. What you asking is $5 million in 16 months of time, and what you can deliver for that is a PEA on Sebieta.
That's my target. That's my goal.
Yeah.
Those things are always plus or minus. Those things are always plus 2, 3, 4 months. But if not delivering a PEA at the end of 2025, there'll be an extremely good reason. Possibly, we see additional exploration potential where we're sure that it's going to be that it's going to add pounds, and we want to bring those pounds in another resource update. There's lots of caveats, but right now the goal is heavy exploration in 2025, resource update, and PEA.
Got it.
By the end of the year.
What about Colorado? What are you doing there? I mean, you have 4 projects. Talk to me about the permitting state of those projects. Well, are they on BLM ground, by the way?
There's a mixture, but there's BLM ground there, yes. But the plan there, to Atkinson Mesa and Monogram Mesa both have about 5 million pounds of historic uranium production, over 20 million pounds of historic vanadium production. Both of those are kind of the 2 main assets of the Colorado portfolio, and what we're looking to do there is simply in 2025 acquire more information about the historic production. Try to acquire the databases related to historic operating activity to form a strategy around those assets. So they're not going to be a big part of the budget in 2025, but we are going to do some early stage work on them to gather the data that we need to put a strategy around them.
But you're not thinking about monetizing them in any way. Like you want to keep them in the premier portfolio.
Yeah, there's no plan. There's no plan to dispose to monetize them at this time. We would certainly be looking at potentially augmenting them through M&A. I think there's opportunities in Colorado that would complement some of those assets. So even though they're not part of heavy work programs, that has a lot to do with the fact that it's not that they don't justify work, but we're prioritizing Sebieta and Cyclone. And as we grow the company, we'll have more bandwidth to advance multiple projects at the same time. But I think the best way to prove value or expose value to the market is through exploration at Cyclone and exploration at Sebieta.
They are costing you money though, right? To hold them?
Yeah, they're not extremely expensive. A couple $100,000 a year, I think, is the land holding costs. Certainly, we could provide exact details, but I'm fairly sure that's about the number. So not extremely expensive to hold on and maintain those assets. And for the potential value there, completely worth it. And as we build a strategy around them, I think that we'll be able to show that they're quite potentially valuable.
In this whole strategy that you're outlining here for me, Colin, it doesn't sound to me like you're going to have to go to the market for capital anytime soon. But under what circumstances would you? It's kind of this approach where you don't take the money where you need it, you take it when it's there. So under what circumstances would you go back to the market?
I think probably the most obvious situation where we'll be back in the market is, with this acquire, explore, develop strategy, when we move on our next acquisition, which is something that, we want to be quite aggressive about, then to carry out those other two components, to carry out exploration and development costs money. So as we grow the company, it's really important to know that when we acquire something, it's because we believe that putting money into it can expose multiples of that money in value. So when we go and, I think American Future Fuel is an amazing example of that. It was a situation where we thought that spending a couple more $1 million on a phase 2 exploration program was going to bring 18.9 million pounds of resource current, and it happened much, much faster than we thought. So we were vindicated for sure, because I think like a current resource of 23.5 million pounds is infinitely better than an 18.9 million historic that requires $2 million to prove it up. My point is that with further acquisition, we're going to look to shore up the cash so that we can carry out the second and third prong of that strategy. We're not acquiring things to park them. We're acquiring things because we think that they're more valuable with some money put into them. And so naturally, as part of that strategy, if you see us making another acquisition, it's likely to come along with financing requirements.
Colin, I've already not been too respectful of your time. I've gone over time as to what you'd promised me to give what you'd promised to give me. What am I forgetting to ask you? This has been a good conversation, in my opinion, but I always forget important stuff to ask people. So what should I be asking you here?
I think that was a pretty fulsome discussion. I think that the most important takeaways here are that we're drilling in Wyoming with the potential to put out results near term. We're planning to drill later this year at Sebieta, and keep your eyes on us on the M&A front. I think that it's difficult to ask questions about M&A, but we intend to be active. It's in our DNA. And we're looking to do things that really augment the existing portfolio and should be accretive. So I just want everyone to keep their eyes on us.
And that's Premier American Uranium, PUR, and the TSXV in Canada. Colin, thank you so much for investing your time in me, sir.
Thanks, Antonio. Really appreciate it.